Hey everybody, my name is Laksh and I was in your Accounting 211 class this past semester, and I figured as a way for me to study for the final exam, but also as a way to help other people learn the topic, I figured I'd make a whole video going over a recap of the entire course. I'll be going over each of the chapters from chapters 1 to 13, and I'll be sharing some slideshows and going over actual examples as well. I put a lot of work into this video, and if you liked it, then I hope that you can like and subscribe and comment something. It helps out the algorithm, boost my engagement, etc. All right, let's start. So real quick disclaimer, this video isn't meant to replace your studying. It's basically just a supplement. Still do your own studying. This is just in case, you want some extra material or you kind of want a very condensed format of the entire course. Also, if you're watching this video from start to finish, you're doing something wrong. I have broken up this video into timestamps in the description for each chapter. Surf throughout the video, pick whichever chapter you don't understand and watch that part of the video first. Also on your screen right now, you'll see a breakdown of the entire course as per the quizzes that we've done. And so pick your lowest quiz grade and watch that part of the video first, and then move on to your second lowest quiz grade. And of course, I would really appreciate it if you watch the whole video. It helps out the algorithm, pushes it up to more people, etc. But again, this is a study tool. It's meant for your own convenience. Watch it if you have time. And also some quick credits. Credits to the University of Alberta for providing the course material. Credits to the Financial Accounting Textbook by Wiley Plus. And credits to Andrea, the professor who taught this course. And also, ideally, you watch the whole video. But if you're in a time crunch, just skip chapters 1, 2, and 4. Again, use the timestamps in the description to do that. I don't really encourage this. If you have the extra 20 minutes, go ahead and watch them. Otherwise, Chapter 3 and the rest of them are really the bulk of the course, in my opinion. All right, Chapter 1, the purpose and the use of financial statements. So basically, financial statements basically provide decision-making aspects for business owners. They help business owners make better decisions, and they can determine the financial health of a company for loans. If you want to get a loan for a business, the loan provider wants to know exactly how well your business is doing because they want to make sure that you're going to be able to pay back the loan in time. So financial statements help provide that. And there are mostly two cohorts of people who use the financial statements. There are internal users who are like managers and employees, and then there are external users. These are investors, creditors who provide you loans, and the CRA, of course, as well as customers who want to invest in the company. So there are three legal forms of businesses. Number one is a sole proprietorship, where the business is owned by one individual person. Number two is a partnership, where a business is owned by more than one person, but it's not incorporated. So basically, in the above two, a sole proprietorship and a partnership, they aren't separate legal entities. The owners themselves are personally liable. So let's say if the business gets sued, then the owners of the sole proprietorship and the owners of the partnership will get sued. Those two aren't separate. The business and the owners are basically the same. And then we have an incorporated business. So this is a separate legal entity as opposed to the first two, where it means if you start a business and if the business gets sued, then the owner of the business is not liable. The company itself is liable. And a corporated company can be private or public. So if it's a private corporation, it's going to be under the ASPE governance. And if it's public, it's going to be IFRS. ASPE and IFRS, they'll come pretty frequently throughout the course, so just keep that on the back burner of your mind. But when it comes again, just remember ASPE is private, IFRS is public companies. All right, so there are mostly three types of business activities. Number one is the operating activity. These are the day-to-day expenses and revenues of the business, and it's basically how the business makes money. For example, a Walmart, they're basically buying stuff and they're going to resell it. So the whole nature of Walmart is to kind of buy things and resell them. So COGS is going to be part of their operating expenses. They want to pay people to sell stuff, so payroll. They're also going to have sales, etc. This will come up in the cash flow statement. So again, this is just an introduction. Chapter 13 will be going into in-depth into all of these. Investings are for basically long-term assets. These are for current assets and current liabilities, whereas investing is for a long-term asset. Lastly, financing activities. This is basically when you get or you pay off funds to finance operations. So you're basically getting money to make money. Let's say Walmart needs money to buy goods. They don't have money, so they get money through a bank to essentially make money. So this is financing of funds. Examples include mortgages, loans, dividends, bonds, etc. And we'll be going more into depth into all of these in the future chapters. So financial statements, there are four main financial statements. Number one is the balance sheet. It's also called the statement of financial position. And it's basically a snapshot of the business's current assets, liabilities, and equity prepared at a date, not a time frame. For example, if you were to look at a balance sheet of December 31st, that would be the balance sheet of December 31st as it is, not from a date period, just a specific moment in time. And when I say current assets, I don't mean like the assets that are considered under 1 year. I mean like the current as in at a specific date of assets, liabilities, and equity. Next up, we have the income statement. So this does have a date range. This is not prepared at a date. And here you have your revenues, your expenses, and all of this, your revenues minus your expenses equals your net income. A common example of an expense is oftentimes COGS. You can also have salaries, etc. Next up, you have your statement of returned earnings, and this is for ASPE. And this is also prepared at a date range. You don't want to say what is my retained earnings for a specific date. You want to say what is my retained earnings for a specific period. This is basically your net income. Retained earnings consists of like your net income. So first off, you start with the opening balance, then you add in net earnings. So this is going to be net income. Then you take away dividends. This equals your retained earnings closing balance. And also you include the dividends paid. Statement of changes in equity is like the statement of changes in equity is like the retained earnings, but for IFRS. It's basically all of the above plus changes in all equity accounts like common shares. Next up, we have the statement of cash flows. So these are all cash inflows and outflows. We have the operating activities, investing activities, and financing activities. And this is important because no matter how many assets you have, you could own tons of buildings, you could have tons of inventory, you could have a lot of assets in your corporation, you still need cash to buy things like COGS and pay staff, etc. If you don't have cash, then you won't be able to function as a business. And unless you're willing to sell off some of your assets for cash, you need to have cash in your statement of cash flows. Again, we'll be going a bit more into this in the actual cash flows chapter. There are some caveats to the statement that I made, and you can stay tuned for that chapter. Also, the financial statements must be prepared in a very specific order. Number one, you need your income statement. This tells you exactly how much revenues minus expenses you have, because in your statement of returned earnings, you need your net income. So this is required to make this. And then you make our balance sheet, which has a whole account called retained earnings. So you need this to make this. And then our balance sheet tells us our cash, which we need to make the statement of cash flows. So there's a very specific order to preparing the financial statements. It's because every consecutive statement needs data from the previous statement, so we prepare them in this order. Chapter 2, so layout of the balance sheet plus some of the ratios involved. So the balance sheet, you need a who, a what, a when. So this is the corporation, this is the balance sheet, and when it's going to be at a date, not a date period, but at a specific date. So your balance sheet, it consists of your assets plus your liabilities and shareholders' equity. So this is going to be on one side of the balance sheet, and this is going to be on the other side. Your assets must equal your total liabilities plus shareholders' equity. In your assets, you have your current assets and you have your long-term assets. This is like your building, property, plant, equipment. Current assets are like certain prepaid expenses, inventory, etc. Liabilities, again, you have current liabilities and long-term liabilities. For example, at a specific time, if you have a bank loan payable, any amount that is paid under 1 year will be a current liability, and any amount that you're carrying in the long term past 1 year is a long-term liability. Next up, you have your shareholders' equity. So this is your retained earnings and your common shares. For example, in all of these accounts, we'll look at, let's say, long-term assets. You will have an account for equipment. Let's say it's just at $50,000. And then we can also have something called a contra account. So in this case, equipment is an asset, right? This means our accumulated depreciation is a contra asset account, as in this number decreases the amount in the asset account. So let's say if we have $10,000 of accumulated depreciation, then our net book value, this is the net carrying value, book value, whatever you want to call it, is $40,000. So we're going to have contra accounts. These are basically the opposite of the account that they're meant for. For example, an asset account would have a contra asset account. You can also have contra sales account if you have like sales returns and discounts, etc. So now let's go over some of the ratios. Basically, there's three kinds of ratios that can exist. Number one is a liquidity ratio. So this is your company's ability to meet short-term obligations. Next up are solvency ratios. These are for your long-term obligations. So this is basically like current liabilities, long-term liabilities. Next up, you have your profitability ratios. This is basically the success of a company to generate earnings or cash. You're going to have stuff like earnings per share, dividend yield, etc. We'll be going over some of the commonly used ratios. So for example, one of the liquidity ratios is the working capital. This is basically your current assets minus your current liabilities. Again, in this case, you want something that is higher than the lower number. If you have two working capital ratios, the one that is higher is generally preferred than the lower one. Next up, we have our current ratio. This is our current assets divided by current liabilities. So it's going to be this number divided by this number. And our working capital is this number subtract this number. So in a current ratio, you also want something that is higher than a lower number. Higher is generally preferred. And next up, we'll go to our solvency ratios. And this is your ability to meet long-term obligations. And in this case, you want something lower as opposed to something higher. For example, there's a common ratio. It's called debt to total assets, where you have your total liabilities divided by your total assets. So it's going to be all of this divided by all of this. And this basically tells you kind of your ability to meet long-term obligations. And you want something that is low because you want less liabilities compared to your assets. And then some of the common profitability ratios are earnings per share. And you want something that is higher as opposed to something that is lower. And another one is price earnings ratio. Again, you want something that is higher than you want something that is lower. This basically means that you want more profitability, so you want something that is higher. And the earnings per share basically calculates the amount of profit per share of a corporation. And the price earnings is the market price of the share divided by the earnings price per share. So you need this ratio to calculate this ratio. All right, chapter 3. So chapter 1 and 2, they're short and simple chapters. I wouldn't stress too much about them. Chapter 3 is really the fundamental aspects of accounting. And if you can understand chapter 3, then you'll be able to understand the rest of the course. If you don't understand chapter 3, then this is going to be the moat between you understanding the course and you not understanding the course. So debits and credits. So basically, I'll be going over this entire chart. I'll be producing this chart in front of you. And essentially, what this tells you is that whatever a business owns is equal to whatever a business owes. This has to fundamentally be true. If you look at your macroeconomics course, we had something like your total income is equal to your total expenses in a country. Kind of similar concept where everything that a business owns, the value of that is equal to what a business owes. So I'll produce this chart in front of you. So basically, let's say if we first just start a business, right? Let's say you started a business, you have your assets is equal to liabilities plus shareholders equity, right? Liabilities plus shareholders equity. That's a weird looking E. Okay, so let's just say this equation exists, okay? Now let's say if I put $5 into this business, my assets is gonna increase by $5 because I literally put in $5 of cash into this business. But for that cash, I issued common shares. So my shareholders equity will increase by $5. Now, just picture this in your mind where a business exists, they have nothing in that business. I give that business $5. Every single part of that business is kind of like I own it. Whatever that business earns, it owes to me. So my assets will equal my equity. Now let's say I need more money. So I'll go to the bank and I'll get $5 of cash from them. And now this is a liability instead. The bank doesn't directly own the business. That was only the equity. Instead, I owe the bank money now. So here in my total asset side, I have $10. And in my total liabilities plus shareholders equity, I have $10. I have $5 that I owe to a different party, and I have $5 that I owe to the actual shareholders. So your shareholders account is consisting of a couple things. Number one, it has your retained earnings. And it also has your common shares. And then your retained earnings account further is broken into a couple things. Number one, revenues, number 2, expenses, EXP expenses, and then number 3, dividends. So for your retained earnings, you add your revenues, you subtract your expenses, and you subtract your dividends. This is essentially the format of your assets plus liabilities. This is essentially the format of your assets is equal to liabilities plus shareholders' equity, and your shareholders' equity just consists of these accounts. So now if we were to kind of recreate this equation, we get assets is equal to liabilities plus revenues minus expenses minus dividends, and then plus common shares. Common shares can also just be considered equity, like this is the owner's equity, so we can just replace common shares with the word equity. This equation holds true for any single business. Their assets will equal their liabilities plus revenues minus expenses minus dividends plus equity. However, we in accounting just prefer positive numbers because you're not going to have negative expenses, you're not going to have negative dividends. These need to be positive. So what we'll do is we'll just move these to the right side of the equation like that. And then instead of a subtraction, this will just be positive. So now our new equation becomes assets plus expenses plus dividends is equal to liabilities plus revenue plus equity. Now, you might have heard of the dealer equation. If you would just like swap around some of these numbers, like if you just put D first, then you put your expenses, then you put your assets, then you equal that to your liabilities plus your equity plus your revenue, you get your dealer equation. Dividends plus expenses plus assets is equal to liabilities plus equities plus revenue. This is how the dealer equation is derived. First, it starts off with your assets equals liabilities plus shareholder equity. Then it breaks that down into your revenues, your expenses, your dividends, and then you also have your equity itself. Now let's revisit our assets is equal to liabilities plus equity. So let's say if I take a business and I physically give them a $5 bill, right? I just give them $5 of cash. Well, cash is their asset and now they own $5. So effectively, it just looks like you own $5. The amount that you own has increased by $5, right? But now this is imbalanced because we have $5 here and we have $0 over here. So how are we going to balance off that other side? So in order to do that, I basically, let's just say I bought the entire business for $5. Like they issued me common shares and now I own all of the business. So in that case, my equity in the business also went up by $5, right? My equity went up by $5. However, that equity, the business does not own. I own. So if I own the equity in the business owes the equity to me. So when you look at your equity, it goes up by $5 in what the business owes to me. So basically, whatever you own went up by $5, but whatever you owe went up by $5 as well. Similarly, let's do the example of the bank. Let's say you get $5 from the bank as a loan. Well, you now own $5 more, but now this side has $10 and this side only has $5. So how are you going to make this balance? So because you got the $5 for the bank as a loan, you need to give that money back. It's not yours. It's kind of like an extra nuisance on you. So it's a liability, right? Liability is another word for nuisance. It's something that you have to pay back. So now their liabilities has increased by $5, but this liability is not something that the business owns. This is something that the business owes to someone else, right? In this case, the business owes $5 to the bank. So now you have $10 of stuff that the business owns and you have $10 of stuff that the business owes. So again, we're good with assets. Assets is just like the asset account. Liabilities is just the liabilities account. Now we need to work out where we get our expenses and our equity and our revenue and our dividends from. If you go back to the previous slide that I made, your equity consists of your positive revenues minus your expenses minus your dividends plus your equity, right? So if we were to look at all of this, you can also break this down into your equity into revenues minus expenses minus dividends plus common shares / equity. So now let's look at this scenario. Let's say that business, they sell stuff and now they have $5 of sales. Well, that sale technically doesn't belong to the business because I own the business. So the money that the business makes through the sales, technically they owe to the shareholders, right? Because it's not the business's money, it's the shareholders' money. So whatever money they make, they owe to someone, which means if you want the amount of sales to increase, then you need to increase what the business owes. Let's just hypothetically say that the business makes $5 in sale. A customer buys a good, they give them a $5 cash bill. So now something that they own increases by 5. Well, this is reflected in their revenue, right? Their revenues increase by $5. However, that revenue technically isn't theirs, it's the shareholders. It's something that they owe to the shareholder. Therefore, the amount that they increase, the amount that they owe increases. I'm just gonna space these out for some so I can write better. Now, just to make things a bit easier, I'm going to move the expenses and the dividends to the left side, just so we're working with positive numbers, because in reality, you can't have negative money. So don't freak out. I'm just going to kind of add this stuff here. We'll make the dividends and expenses positive, and everything is still equal. I did not undo anything that I wrote. Everything's still there, but now we're just going to focus on expenses and dividends. So we understand that whenever your assets increase, the amount that you own increases. Whenever your liabilities increase, the amount that you owe increases. Whenever your equity increases, the amount that you owe increases. And whenever your revenues increase, the amount that you owe increases, because the revenue isn't the businesses, it's the shareholders. When your revenue increases, you owe it to the shareholders. So now let's look at expenses and dividends. Let's say in order to sell something, you have to buy something, right? So oftentimes your business will have a COGS expense, your cost of goods sold. So let's say if you buy something for $2, well, your asset side, the amount that you own decreases by $2, but your expenses, they increase by $2, right? And this is true because if we just subtract 2 here and we add 2 here, it equals 0. So technically we did nothing on this side of the equation. So we're still in balance, that's fine. But whenever you increase your expenses, you are taking away money that would have been the shareholders. Let's say if I give the shareholder $10, right? That's my net income. But let's say now I have $2 more expenses. They're only getting $8 now. So instead of owing them $10, I owe them $8. That means I basically, instead of owing them $2 less, I can also rephrase it as me owning $2 more, right? Instead of owing 2 less, I own 2 more. So now you can write own over here. So whenever you make an expense, your asset, like let's say your cash, it will decrease by 2, but now your expenses increases by 2. So the net change is 0, but now your expenses, they decrease what is owed to the shareholder, so they increase what is owned by you. So now expenses are taken care of. Now let's explain dividends. Dividends are again what is kind of owed to the shareholder. Your retained earnings is basically your retained earnings is your net income. This is your revenues and expenses. We've taken care of this. We won't worry about this. Minus your dividends, right? Your retained earnings is what you owe to the shareholders. But when you subtract dividends, you decrease what they owe. Again, going back to the expenses, when you decrease what you owe to someone, it's another way of saying you're increasing what you own, or at least that's how I like to phrase it in my head. So when you pay out dividends, you are decreasing what you owe to the shareholders, and instead you are increasing what you own as a business. So, well, let's say you pay out $2 of dividends, we can kind of like consider it like that. If you pay out $2 of cash dividend, then your cash is decreasing by 2, but your dividends are increasing by 2. So now we've worked out your assets, expenses, dividends is equal to your liabilities, equity, and revenue. Again, you can rephrase this however you want. It's all going to equal a dealer either way. I just have assets and expenses before D, but it doesn't matter. But now you have own and owe, right? We're clear on that principle. Now I want you to take the word own. I'm going to do it in a different color. Take the word own and replace it with debit, and take the word owe and replace it with credit. That's all you're doing. Your debit and credit, they aren't like your debit card or your credit card. Debits aren't inherently good, credits aren't inherently bad. All it means is whenever you debit something, you are increasing what you own, and whenever you credit something, you are increasing what you owe. Now let's go back to this example. So if you increase your assets, you increase what you own. If you decrease your assets, you decrease what you own, right? So now let's just take the word debit and put it in place of own. So we can debit our asset to increase it. And when you decrease what you own, you increase what you owe. If you're increasing what you owe, we can replace this with credit. So whenever we are decreasing our assets, we credit them. Whenever we are increasing our assets, we debit them. Same thing with expenses. Whenever you increase your expenses, it's something that you're owning, so you debit them to increase, and the exact opposite would be you credit them to decrease. For dividends, same thing, debit to increase, credit to decrease. Okay, now for our left side of the equation, that's all it is. For your dividends, your expenses and your assets, to increase them, all you do is a debit because that increases what you own, and to decrease them, you credit them because that increases what you owe, or in other words, it decreases what you own. Okay, now that's taken care of. Now let's look at our liabilities plus equity plus revenue side. When you have an increase in liabilities, this is something that you owe to someone. When you increase something that you owe, you credit it. So we can credit our liabilities to increase it. The exact opposite would be debiting our liabilities to decrease them. Now going over to our equity, when your equity increases, you owe it to the shareholders. Again, when you increase something you owe, you credit it, and when you decrease it, you have to debit it. Same exact concept applies to revenue. When you increase your revenue, that's something that you owe to the shareholders, so your credit increases and your debit will decrease automatically because that's just a flip reaction. Now, in order to make it look all nicer, we can have our dividends plus expenses plus assets is equal to our liabilities plus equity. I'll just write it EQ and EX to differentiate between expense and equity, plus revenues, right? So for all of these things, if you want to increase them, you debit them. If you want to decrease them, you credit them. And for all of these things, if you want to increase them, you credit them. And if you want to decrease them, you debit them. Okay, now this whole page looks like a mess, but essentially this is the table that I've produced. Your assets is equal to your liabilities plus shareholders' equity. In order to increase your assets, you debit them. In order to decrease them, credit. And for liabilities and shareholders' equity, to increase them, you credit. And to decrease them, you debit. Now your shareholders' equity is broken down into your common shares and your retained earnings. If you want to increase your common shares, you credit them. And if you want to decrease them, you debit them, right? If you want to increase your shareholders' earnings in general, you credit them. So by definition, all of its components, you should be crediting them. Sorry, I forgot to write the expenses and the revenue before, but either way, in your retained earnings, it's broken down into your revenues, your expenses, and your dividends. Your revenues is positive, and you subtract your expenses, and you subtract your dividends. So again, because this is positive, this is positive. Whenever you increase this, you credit, which means whenever you increase your revenue, you credit. And because expenses and dividends are negative, right? I just like to think of it like math. When you multiply something by negative, you kind of have the opposite effect. So basically with your expenses and your dividends, you would decrease them. However, also think about it like math. If you have a negative like expense on this side, well, you can just move that to this side and make it a positive expense, which means you would just have debits to increase and credits to decrease for both your expenses and your dividends. This is how dealer is derived. This side, you debit to increase, credit to decrease. And this side, you credit to increase, debit to decrease. This is basically the crux of chapter 3. This is a very crucial portion because every single thing we do going forward in all of our journal entries, we need to be mindful of exactly what it is we're doing to that account. Are we increasing it or decreasing it? And what type of account is it specifically? Is it an asset? Is it a liability? Is it common shares, etc.? Now let's look at some common accounts. For example, you have your assets, your liabilities, and dividends. and then you have your revenues, expenses, and equity, and common shares. This is how dealer is derived. Now, if we were to look at your debit and credit balance, what that means is what is the normal balance, right? So what it takes to increase that account. For example, for your assets, if you want to increase it, you have to debit them. Remember, we're going back to this slide. If you want to increase your assets, you have to debit them. That just means that assets have a debit balance. For example, I'll just pick another random one. Let's say you have revenues. If you want to increase your revenues, then you have to credit them, right? So revenues have a credit balance because you need to credit them to increase them. This is all that means. If something has a debit balance or a credit balance, all it's asking is what do you do to increase that specific account? You don't need to worry about it too much, but these are all the dealer accounts and what it takes to increase or decrease them. All right. Lastly, whenever we do journal entries, we need to know when to record. You only record a journal entry when it changes your financial position, as in something on the balance sheet will change, either directly or indirectly through the income statement. For example, if your asset or your liability or your shareholder equity changes, then you record the journal entry. If you just talk about changing it, then it doesn't happen. For example, let's say if you actually pay $10 to buy some inventory, then that is a journal entry you would record. But if you just tell someone, hey, in 2 weeks time, I'm going to buy something for you, then you didn't actually change your cash. You didn't actually change your inventory. So pretty much nothing happened. All right, that is chapter 3. Please rewatch that part of the video. I butchered some of it up when I was explaining it, but that's just the way I understood debits and credits. If it helps you, then I'm really glad. Otherwise, stick to just memorizing dealer. So chapter 4, accrual accounting. This is again supposed to be a super quick recap. Basically, there's two kind of accounting methods. There's cash and accrual. Cash is when you record revenue when cash is received, like a physical cash. Actually, it doesn't have to be a physical dollar bill. It can be bank receipts or credit cards, debit cards. But basically, whenever cash is transferred, we call that cash accounting. And whenever your revenue or expense is earned or incurred, then that's called accrual accounting. We do accrual accounting. This is what we focus on. For example, I can buy inventory from someone, but I just tell them, hey, I don't have money right now. I'll pay you back in 2 weeks. Technically, I didn't really have a cash exchange because I didn't give them money. I just said I was going to give you money in exchange for the goods that I have received. Therefore, in cash accounting, I would not record that transaction because cash didn't go in or out. But in accrual accounting, I would record it because now it's an expense that I have incurred. I got the goods, but I can't pay it yet. So that's a liability that I need to take care of. It's an account payable. Again, quick example, I just went off my head, but you give someone $5 in exchange for office supplies. You receive $5 worth of office supplies from someone and you say you'll pay them back in 2 weeks. This is cash because you actually gave someone $5. So this would be cash accounting. And you received $5 worth of office supplies and say you'll pay them back in 2 weeks. Again, this is accrual. I can't spell today. So prepayments. So prepayments is basically you have your cash first and your action later. For example, your prepaid liability, this is an asset. So what you're doing is you're just gonna pay off some other liability for the future. So let's say if you have a loan that's worth $1,200 and you need to pay back $100 every month, that's how the bank will report it. But you just decide, you know what, for the next 6 months, I'm just gonna pay off that $600 because I don't want to worry about it now. So it's basically a liability that you've already kind of taken care of, hence prepaid. So you already paid them $600 cash, except the action of actually recording that liability as a decrease will come later. And another thing is unearned revenue. For example, you take the cash from someone, but you haven't given the service yet. This is unearned revenue because technically you haven't provided the service in exchange for revenue. So this is a liability. In this case, in both of these cases, the cash came first, then the action came later. The exact opposite are accruals. This is where your action comes first and your cash comes later. For example, your accrued revenue, this is an asset, where basically this is your accounts receivable. You got $5 worth of supplies from someone, but you said you'll pay them back later, so the cash is coming later. But now that would be your accrued expense actually, and your accrued revenue is basically your accounts receivable, where you gave goods to someone, you sold someone to something, but they said they'll pay you back later, so that's an account receivable, and that would be your accrual action first, cash later for an accrued revenue. All right, chapter 4, we're supposed to be super quick, short, and simple. I'm going to skip over chapter 5 and chapter 6 in this video because this won't be on the final exam. However, going back, like I will make a video on this just so I can have just so I can say that I did a recap of the whole course, and I'll upload that separately. But just for time constraints, I am going to skip over to chapter 7. So chapter 5 and chapter 6, I'll skip over it. And we'll go over chapter 7. So this is basically just cash management and bank reconciliation. So some of the basics of cash management. There can exist various types of control systems to manage cash. Cash is probably one of your most important assets because this is the asset that you use to purchase other assets. You can't just go to someone and be like, hey, I'll give you like six cereal boxes for like 2 of your apples. Like if you were grocery stores exchanging stuff, you can't really do that, but you can say like, hey, I'll give you $20 for 6 of those cereal boxes, right? Cash is what you use to buy things, and therefore you need to protect it because it's very important, and it is also very liquid, meaning liquidity is basically how quickly you can exchange that asset for cash. In this case, cash is just cash. There's no liquidity about it. You just have it. Versus something like a cereal box. A cereal box is something that is kind of liquid where you can like exchange it, you can sell it to someone and then you can get cash in place of it, versus something that is completely like very, very less liquid is like a building, where if you want to exchange a building for cash, then you're going to have to go through like 6 months worth of like legalities and everything to sell off that building in exchange for cash. Anyways, that was kind of a side tangent, but basically cash is important. You got to protect it. Here's how. Number 1 is you can have security measures, like straight up just like lock up cash in a bank deposit box. Again, verification measures is like, let's say if you're giving a check to someone, you can have one person write the check, you can have another person sign the check, and you can have a third person mail the check. So that way you have 3 sets of eyes on the check, so you can make sure that the check is for the correct amount, that you're not actually giving away more money than you should have. And cash is loosely defined. It's defined as coins, currencies, checks, and money orders. You can have cash on hand, deposits in the bank, debit card slips, etc. They can take a variety of forms. I think it's pretty intuitive when something is considered cash. Another example is cash equivalents. So, for example, let's say if I have a GIC, like I invested money, but I can pull it out pretty much whenever, then that would be considered a cash equivalent because it must be readily convertible into cash and have very little risk. For example, a building, that is not considered a cash equivalent, even though I technically could sell it for cash. It would take me a lot of time, money, energy, resources to sell a building for cash, so it's not considered a cash equivalent. Let's look at a GIC. For example, a GIC typically under 3 months, it's considered low risk because it's very close to its maturity, and this is considered a cash equivalent because it can really easily be converted to cash because you just got to wait 3 months and it's guaranteed either way. Another thing is you can have something like a petty cash account. So oftentimes offices, what happens is like they'll have a lot of cash going on, right? But they have like dated expenses, like maybe you want to like buy everyone a coffee or you want to buy a little bit of office supplies, etc. You'll just have a separate cash account just to have those minor expenses. This is called petty cash, like you're just using it for petty purchases. That's how I like to think of it. So again, petty cash, going back to our chapter 3, petty cash is an asset to increase your debit, and you are taking your cash and you're just decreasing it. This is how I would like to actually draw it. Let's say if you have your balance sheet, right? Your assets is equal to liabilities plus equity. This is an equal sign. Don't worry about this for now. But both these are your assets, right? Let's say if you have 100% in cash right now, but you want to get some petty cash. So all you'll do is you'll just like create $20 of petty cash and like 80% cash. So your 100% cash now decreases to 80 and your 0% petty cash increases to 20. When you are like doing this entry, all that's changing is the position of this line. Like it'll be, instead of 20/80, it can be like 50/50 or 60/40. Whenever you're transferring assets, the liabilities and equity are unaffected. It's just a portion of the assets is what changes. I'll go over this diagram again. I think it's really helpful. This is just like an example where I can't really use it well enough, but in future examples, when we're talking about actually selling off stuff for cash, it'll make more sense. So bank reconciliation, this is very important because oftentimes your bank and your book balance might not match. This is mostly because of time delays, because let's say if you pay off like your expense as a check. You can record it right away in your books, but it can take sometimes weeks to actually get a check physically delivered by mail to your vendor. So there can be time delays, and we always go with the bank as being correct. Our books can sometimes be incorrect, but our bank is very likely not incorrect. So we just go with whatever the bank balance is. And what we need to do is you can go over this you can go over the in-class example of this better. They'll provide more value to you than this slide will. But basically, you can have commonalities between your bank balance and your book balance. Anything that's common, you don't need to worry about because it's already been accounted for, right? So the discrepancies, that's what we need to worry about. On your bank side, what you need to do is you need to add the deposits in transit and you need to subtract outstanding checks. So let's say if you have a check that you're depositing into your account, except it's just like in the process of like being transferred, then you need to add it because on your book, you'd already accounted for it, but in your bank, the bank has not deposited it. Also outstanding checks, like you pay someone something from your bank account, that person just hasn't cashed in your check, so it's not reflected in your bank account, but it's reflected in your book account. So you need to subtract that. For your bank side, add deposits, subtract outstanding checks, you're good. Next up, your book side. So oftentimes your customers will pay you, they'll just pay you a bit late, so that check will be added into your bank account a bit late. This is your electronic fund transfer, so you need to add your EFTs and you need to subtract bank charges. So your bank will charge you as a fee for using their service, and the bank will account for it, but your book might not, so you need to subtract that from your book balance. And you also need to subtract or add check errors, because if you only have like an $800 check on your book balance, but in reality it was like $1,000, then you need to like subtract that check error. Very, very rarely the bank can be incorrect. I know this contradicts what I said earlier, but like very, very, very rarely the bank can be incorrect. In that case, you would add. You would also subtract non-sufficient funds checks. So like, let's say if someone gave you money, except like that check bounces, they just didn't have enough money to give you, so then you would subtract that. So these two above things, your book side and your bank side, they should match, they must match. And to do that, you need to add deposits, subtract outstanding checks to your bank balance, and add EFTs, subtract bank charges, subtract check errors, and subtract NSF checks from your book side. So your bank side, that's already taken care of, but for your book side, you would need to journalize these transactions. So for example, you would debit bank expense, credit cash. Again, with this one, I would really recommend going through the in-class example with chapter 7. I think that'll just like really stick it in your mind better than I can. And chapter 8, receivables. This is kind of like, chapter 8 is where the course really starts to pile up. So even my explanation, they'll be way more detailed now, and I'll actually be doing examples in front of you guys. So receivables general recap. A receivable is basically money that is owed to a business. You sell something for $5. The person can't pay you right now. They'll pay you back later. That is the amount that you have to receive. This is money that is owed to the business, and it is usually due to credit sales. And this is recognized as revenue under accrual because we recorded when it is earned. So technically cash wasn't transferred because they said they'll pay you back later. However, we still record this revenue because it's earned, and they'll have different terms associated with it. So let's say you sell something for $8,000 and you'll say 2-10 net 30. What does that mean? What it means is I sold you this amount for $800. You need to give me back $8,000. You can, if you pay me back within 10 days, then you can get a 2% discount. If you pay me back within 30 days, then you just have to pay me back the whole net amount. That's what that means. I'll give a better example here. You sell something to a customer on account. Whenever you see on account, think about receivables. Eventually you'll think about payables, but in this case, receivables for $100. What you're doing is you're increasing your amount to receive by $100. This is your account receivables, and you are increasing your sales by $100. And let's say they pay you back a week later. Ignore this. This doesn't apply to this. This is just like they just pay you back. In this case, you would increase your cash and you would decrease your receivable. You're decreasing your receivable is because you've received it already. It's taken care of. Your cash is now increasing. And the way I like to think about these kind of double entries is like you're debiting your accounts receivable, right? And then you're crediting your sales, and then you're next entry is you're debiting your cash and you're crediting your accounts receivable. In math, you've learned about cross multiplying. I just like to think of it this way: when you cross multiply this, your account receivables basically just cancels out. So effectively, you're just left with your debit cash and your credit sales, right? This is just a way that I like to think about it. All it does is your account receivable just gets canceled out. And yeah, now let's go over the discount example. I didn't go over this in the last slide, but let's say you sell something to a customer on account for $100. The term is 2-10 net 30. What this means is if you pay me back within 10 days, you can get a $2 discount. If you pay me back within 30 days, you have to pay the net amount. And let's also add another contingent. Let's say you have a 5% penalty for late payment. As in, if you pay me past this 30-day amount, you're going to have to pay me a 5% penalty. So the entry just to sell something is going to be the same for every single time. You're just going to increase the amount to receive by 100, debit account receivable, and you're going to increase your sales by 100, right? Credit sales. So there's three options. Either they pay you back within the discount period, either they pay you back within the net window, or they pay you back late. So let's say they pay you back within the discount period. Let's say they can, if you want to give them a discount, they have to pay within 10 days, but they pay within 5 days, right? So they're within the discount window. So what that does is they've already taken care of their liability, right? Like they've already paid you. The amount that you set out to receive has already been received. You can just clear out account receivable. You don't have anything to settle with them anymore. They've already given you what you needed to receive. Account receivables is done. Cool. So that's credit for $100. Well, now we need to come up with $100 between cash and discount. So these two amounts must add up to $100. So just visualize this. You tell someone that you need to give me $100, but I'll give you a 2% discount, which means they won't give you $100 anymore. They'll give you $100 minus 2%, which is, in this case, just for easy numbers, it's going to be $98. So they're going to give you $98 instead. But now your $98 doesn't equal your $100. You need to come up with that $2 somewhere else. And in that case, you're going to increase your account. It's just called sales discount because you gave them a discount on their sale. So it's going to be $2. So your total debits, 98 plus 2, add up to your total credits. In this case, it's just 1, which is $100. Now let's say they pay you back on the 20th day. This is option 2, within the window. So what they're doing is you're getting rid of your accounts receivable. That's already done and taken care of. And they're just going to give you $100 cash because they're out of the discount window. They just got to pay the net amount, which was $100 already. So your debit cash just becomes $100. Lastly, let's say they pay you back on the 45th day. This is way outside of that net 30 window. They pay you back after like the acceptable period. So you charge a 5% penalty. What this does is your accounts receivable, in this case, still like all the other ones, you settled your account receivable. You got what you set out to get. You got what you set out to receive. So your account receivable is just $100. That's taken care of. But again, visualize this. You tell someone, hey, you got to pay me back within 30 days. Otherwise, I'm going to charge you 5% more. Well, what that does is if you set out to get $100, but you're going to charge them 5% more, realistically, they have to give you $105 now. So they're going to give you $105. Your cash will increase by $105. But now your debits doesn't equal your credit anymore, right? Your debits are 105 and your credits are 100, which means you need to come up with $5 in some kind of credit, right? In this case, it's going to be your interest revenue because this is extra money you received because the customer didn't pay you back in time. And in this case, your credits will equal your debits of $105. All right, let's go over bad debt. So what if someone doesn't pay you back at all, right? This is when their accounts payable window has gone on for too long, right? Like in this case, they were on day 45 of a 30-day window, but let's just say they're on like day 90. That is so far into the future, right? There's absolutely no way that they'll probably pay you back. So what we do is we debit a bad debt expense and we credit AFTA. AFTA is account allowance for doubtful accounts. Don't worry about this just yet. I'll be going over an AFTA deep dive, but basically all you're doing is you're increasing your bad debt. Like, hey, I now have extra debt. This is an expense for me. To increase my expense, I got to debit it by $100. And for credit, you AFTA. You technically could credit your accounts receivables because you're decreasing the amount that you have to receive. However, we go with AFTA because it is common practice, because you want to know you want to know exactly how much the amount that you are not getting is because of doubtful accounts. I'll go over that in a bit more detail. That was like a very jumbled up description. But basically, not being paid back is common in some industries like utilities, etc. So they have a whole other account for potential debt. They budget for it. It's called AFTA, Allowance for Doubtful Accounts. Instead of waiting until the customer doesn't pay, some companies just estimate the losses ahead of time using AFTA. So this estimate is usually a percentage of the credit sales. So for example, I'm going to sell stuff to my customers. On average, I think that 6% of them aren't going to pay me back. Now my AFTA balance is 6% of my account receivables. Let's go into a bit of a deep dive because this can get confusing. I probably jumbled up my explanation a little bit, but anyways, let's say there's two types of ways of kind of measuring out AFTA. There's percentage of receivables, and then there's aging bins. Percentage of receivables is like, on average, whatever I sell for credit sales, which is account receivables, 6% won't pay me back. So I got to budget 6% for doubtful accounts. Next up is aging bins, where basically, if you think about it logically, the longer your accounts receivable window is, the larger the bin percentage. Let's say if someone is supposed to pay you back within 30 days, well, that's reasonable. But now let's say someone is required to pay you back within 1 year. Well, now that's a whole year worth of time where you might not receive your money. So that's now more risk. More risk means a higher percentage that you have to budget for. The longer the window, the less likely someone is to pay you back. Quick little summary. So your AFTA is a contra asset account. Remember back from chapter 1, we'll have like an asset account. Account receivable is your asset. The contra account just reduces your asset. So on your balance sheet, you can show your net account receivable, which is just your account receivable minus AFTA. This is also known as your carrying value. It's also known as your net realizable value. Also, you can just straight up show your accounts receivable and AFTA. So that way, whoever is looking at the financial statements, they'll just have to like subtract this amount either way. Essentially, it's the same thing. It just depends on your preference and whatever the preference of the financial statements user is. Okay, so how do we set up AFTA? So first you have to say that, okay, I don't think this person will pay me back. So I'm gonna debit my bad debt expense, and then I'm going to credit my AFTA. I'm just gonna increase this allowance for doubtful accounts. So we can technically just credit accounts receivable, right? That's essentially doing almost the same thing because your AFTA is going to decrease account receivable either way. So we technically could just decrease it to begin with. However, we use AFTA instead. We increase AFTA to be subtracted from AR minus AFTA. We're essentially doing the same thing. AFTA is preferred in common practice because this just gives like an extra statistic for managers, like, okay, exactly how much of my sales am I budgeting for that won't give me back. Just go with AFTA. If you have to memorize it, go ahead, but try to understand the concept of it. And AFTA should have a credit balance because we're subtracting our contra account from our asset account. Our asset account is debit. The contra account has to be opposite. So the contra account in this case has to be credit. And another tip is like use T account for calculations. So let's just go over an example. Let's say if you have $11,000 that you determine to be uncollectible. One example is, let's say you have $1,000 in your credit balance of AFTA versus you have $1,000 in a debit balance. So this is how your T account will look like. Where basically, let's say if you have $1,000 in credit balance, cool. You determine 11,000 will be uncollectible, which means you want to end up with $11,000 in your credit AFTA. What do you got to do to this 10,000 to make it 11,000? You got to add 10,000. So you're going to credit AFTA by 10,000. Now let's assume the opposite scenario where basically instead of 1,000 credit, you have $1,000 debit balance. Cool. So what do you got to do to this $1,000 debit to make this 11,000 credit? You got to increase it by $12,000, right? Think of it as like minus 1,000 plus 12,000 is equal to 11,000, right? That's just how I like to think of it. Okay, and setting up AFTA doesn't automatically mean you count it as a loss. It's simply a budget. Let's just say you have a corporation and determine that 6% of the sales won't be paid back. So that doesn't mean that 6% is automatically just wiped out. That's just, you're just budgeting that 6% won't be paid back. But let's say you do pay it back, then it's just gonna go into your receivables at some point. Cool, so your AFTA example. Company ABC has determined that company XYZ will not be able to pay their outstanding accounts receivables of $650 as they have gone bankrupt. Record this entry. Cool. Before I go over this example, I want to go over like your asset diagram. You have your assets equal liabilities plus expenses. Let's just say your asset box look like this. We don't really care about this for now. And then let's say, now I want you to realize this entry, debit, bad debt expense. I'm just going to abbreviate for a lot of stuff. Just like pay attention, I guess. For 650, and then credit AFTA for 650. The same entry as before. When we set up the budget, this has already happened. This has nothing to do with this question just yet, or honestly at all. This has already happened. You don't need to worry about it. Your AFTA account already has $650 worth of credit balance. So basically what's going on is what you have is in your asset side, you're gonna have your like a little bit of cash or whatever. You're gonna have like some accounts receivable, and then you're gonna have like your AFTA, which would have been a part of accounts receivable. You need to write off $650 as now you know for sure that thing that you budgeted for is not going to happen at all. They're not going to pay you back. So you need to write it off. How does that writing off entry work? The way I like to think of it is that when you just say that you're not going to get paid, you just need to wipe out $650 worth of value from your accounts receivable. So all you got to do is you just got to wipe out this value, and you got to wipe out $650 worth of your account receivable. When you do that, you're basically doing the same thing because your AFTA is subtracted of your accounts receivable. So don't think of it as two $650 wipeouts. It's just one $650 wipeout. So you're wiping out $650 worth of value. This is how the entry will look like. You're going to debit your AFTA by $650, and you're going to credit accounts receivable by $650. I'm going to explain this entry in words. You are decreasing your AFTA. Remember, AFTA is a credit balance. So if you debit it, you decrease it, which means you had an allowance for $650 of uncollectible. Now you know for sure that $650 won't be collected at all. So you got to get rid of your allowance. If you get rid of your allowance, you got to debit it. Next up is account receivable. You hoped that you were going to receive $650 worth of stuff. Now you know for sure you're not going to receive it at all. So you got to get rid of your receivable, or at least reduce it by $650. To reduce your receivable, you credit it. So you are reducing it by $650. Essentially, I like to think of it as wiping out $650 worth of value. That's just what makes sense to me. And then this is part one. Okay, part two, bullet point 2 is 6 months later, the company's like, hey, you know what? We have some money now. We want to be nice. We'll pay you back $300. Cool. So how do you do that now? Step one is you gotta reinstate accounts receivable. In this entry, we wiped out $650 worth of value. In the second entry, they say they're gonna pay $300 of it back, so we gotta add $300 worth of value back. So if this entry was for wiping out value, this entry is for adding back value, then it's safe to say this entry is just gonna be the exact reverse of this. So instead of debit AFTA, we're going to debit accounts receivable, and we're going to credit AFTA. Not for $650, it's going to be for $300 because they're only able to pay $300 of it back. We got rid of $650 worth of value. We added $300 worth of it back. That's how the adding back portion works. Step 2 is you got to account for the actual receivable of cash, right? So to collect cash, your cash is increasing, so you're going to debit cash by $300. Well, that cash came from your receivable. I'll paint it in this scenario too. I really like this diagram. Where let's say this is like your portion of cash and account receivable. So you're increasing your cash, right? And in order to increase your cash, you gotta take out your receivable. You already received it. That received portion is just being transformed into cash. So think of it as like the ratio is just switching a bit. Instead of this, now cash is going to be increased by 300 and your accounts receivable is decreased by 300. So debit cash 300 to increase it, and we're going to credit our account receivable by 300 to decrease it. Okay, really quick summary of the whole process. This part has already happened. We have already budgeted that they aren't going to pay us back. Turns out our prediction came true and they actually aren't going to pay us back. So we need to wipe out $650 worth of value, both from accounts receivable and AFTA. Turns out they're nice people. They're going to actually pay us back a little bit after all. So we need to add back some of the value, right? We are reinstating some of the value. So in order to do that, we're going to do the reverse of wipeout to just like reinstate some of the value, and it's going to be for whatever amount they give us. In this case, it's 300. And then lastly, we reinstated that value. Now we just actually got to collect that value, which is just like your cash entry. Go over this a few times. There's tons of examples in the actual slideshow as well. Do the in-class activities, etc. As I said, this is a supplement to your learning, not a replacement. And lastly, and now let's go over some of the ratios. So your accounts receivable turnover ratio is basically how many times are you replacing your accounts receivable with new accounts receivable. So let's say in a given year you have like $1 million worth of credit sales, and on average, let's say you have $100,000 worth of gross accounts receivable, right? Let's say this is 1 million, this is, let's say, 100K, right? That means you're on average replacing your credit sales, your accounts receivable 10 times. In this case, you want something that is higher as opposed to something that is lower. This means that you're just getting more people, you're collecting more essentially. And next up, the age of accounts receivable. You take this number, your AR turnover ratio, and you divide it by 365. This just tells you how long does it take for you to recover your accounts receivable. In this case, you want something that is lower as opposed to higher, because with lower, it takes you less days to collect your receivables. With higher, it takes you more days. Pretty self-explanatory. And okay, now let's go over notes receivables. This is a kind of a complex topic, but it won't be touched on too much in the receivables. It'll be touched on more in the payables, chapter 10. So your notes receivable, it's basically just an accounts receivable, but now there's a legal notice and there's also an interest involved. With your accounts receivable, you would have just been received money, but with a notes receivable, now like you actually have a legal claim, and now there's for sure interest involved because you're basically kind of lending money to someone and you're expecting them to pay back with interest. So the interest is always calculated at the face value of the note times the annual interest rate times the portion of a year that interest rate takes into effect. This equals your interest. This is not on the formula sheet. You should memorize this. If you do enough calculations, this will just automatically be burned into your brain. But now let's go over an actual example. Let's do 8.4. Okay, so entry 1. The Miller Corporation has the following selected transactions for notes receivable. So entry number 1, they have loaned $48,000 of cash to Alex Bouchard on a 1-year 8% note. So what's going on is that they loaned cash to someone. So what's happening is that they're going to credit cash. We know that for sure, right? If they loan cash, their amount is decreasing for cash, and this amount was $48,000. We got rid of 48K cash, and now we need to collect this amount, right? Because we're not giving it away for free. So we're going to have a notes receivable. We're going to debit notes receivable. I'm just going to abbreviate it like that. Now, notes receivable, this is an asset because it's something that you will receive. Assets, to increase them, you debit them. So this is what it looks like. And I'm also just going to write kind of number 1 here, just so we know that this is transaction number 1. Cool. So that's it for transaction number 1. Transaction number 2, we sold goods to Wright Inc., receiving a 3-month 6% note for $8,400. The cost of the goods was $5,000. So I'll just I already know that I sold goods that originally cost me $5,000. This is kind of a throwback to chapter 5. I don't have that in this video, but you can look at the class examples. But basically, if you're selling goods worth $5,000, what's going on is you're debiting your COGS, your cost of goods sold, and you're crediting your inventory. Okay, sorry for my bad handwriting. Right, so COGS is an expense. As we recall, to increase expenses, you debit them. Inventory is your asset. When you get rid of inventory, you're selling 5K worth of it, you need to credit it. So this amount was just for $5,000. And I missed my 48K debit over here. Cool, so we're still in balance, everything good. Okay, so the second part of this entry, we sold them goods. We needed to receive money. They're not going to pay us back yet. They're going to pay us back later. So we need to collect money from them, which is going to be debit accounts receivable. Now, this isn't actually the entry. I'm just going to do what originally would have happened. Originally, we would have increased our account receivable and credit sales, right? Because we sold the money. However, instead of the account receivables, we gave them a note instead. So what we ended up doing is, instead of account receivable, we debited our notes receivable, and we credited our account receivable, right? If you think back to like my asset box, you would have like your notes receivable and then your accounts receivable, right? Like, let's just say your accounts receivable was at 100%, but now you added some note receivable. So now your account receivable goes down by a bit, hence the credit, and your note receivable goes up by a bit, hence the debit. So this essentially would have been the original entry. However, since we first debited accounts receivable, then we credited it, we can basically just get rid of this, and the actual entry just becomes debit notes receivable, DR notes receivable, and we would have credited sales, right? That's basically what now the correct entry is. This, I just showed you how we got to that entry. In an exam, just go ahead and write this if you understand it. And then this is for $8,400, sorry. And then the credit matches. Okay, cool. So that's number one taken care of. Number two is done. Now let's do number three. So number three, we received a 6-month 7% 16K note on account from Barnes Corporation. So what this is we received a note. We received something. We own something. We debit it. This is our notes receivable. And we are crediting our accounts receivable. Same concept as before, except our on account is just like our credit of account receivable. So now this is for 16K. Okay, number three is taken care of. Let's do number four. So at number four, we accrued interest on all notes receivable at the year end. So the year end for this corporation was, let's just say it's December 31st. That just like makes sense for us. Actually, it does tell us December 31st is like the year end. So we need to accrue interest for all of them. So what happens is, just to the side, my math, what it becomes is, the first note was for $48,000, right? And this is at 8% interest, so times 0.08. So look at the dates. We loaned this note. We received this note on November 1st. It is now December 31st. That's 2 months, right? November 1st to November 30th, and then December 1st to December 31st. So that's for 2 months out of the 12 months in a year. So we need to appropriate this interest amount for the specific time that we're collecting it for. When you do the math, it becomes $640. Next up, we have that $8,400 note, and this was at 6% interest times 0.06 times, and we gave this on December 1st, so it's only been 1 month. So we're collecting 1 month's interest out of the 12 months in a year. When you do the math, this comes out to about $42. And then lastly, we have that $16,000 note. And so this was at 7% interest times 0.07. Now here's something that's a bit tricky. So if you look over here, we loaned this note on December 15th. That's only 2 weeks for December 31st. In an exam, like it would be like better numbers. Like this can either be like 2 out of 52 because it's 2 weeks, or it can be like one out of 24. So it's a bit weird here, but let's just go with months because we're going with that. So this is for half a month, right? Like 0.5 out of the 12 possible months in a year. This is the same as 1 over 24. Use whatever you want. I just go with months. If you do the math, this comes out to about $47. So when you add up all of these, the number that you get is 729. So we are basically accruing $729 worth of interest for all three notes by the year end. So our entry for that becomes debit interest receivable, and we are going to credit our interest revenue. Interest revenue. This is for $729. Now we just like put this all in one entry. That's what the question asked. If you wanted to, like, you could have the debit interest receivable, credit interest revenue for all these amounts, 640, 42, 47. At the end of the day, when you do your T account on your interest receivable and your interest revenue, it would be the exact same number. It would be 729. Here you just break it up into three parts. If that's what helps you do it, then go ahead. This math, I'm just gonna move it off to the side. Hopefully you understand it. If not, just rewatch the video. I'm just gonna get rid of that here. Cool. So that's been taken care of. All right. So now, journal entry number 5 is we collect the amount owing on right note. Also, if you look at 5, 6, and 7, we're basically just collecting the amount owing. What I'm gonna do is I'll just go over one of these, and then you can basically just copy paste the exact same procedure for number 6 and 7. If you really want like a in-depth explanation of everything, then you can watch the in-class kind of video, the lecture recording, because the professor goes over all of those entries. I'm just going to do one. So we're collecting the amount owing on the right note. So the right note was for $8,400. And in this case, we're going to have a couple entries. So we're going to have the cash because we're being given cash that we originally loaned. So that was for whatever amount that we'll calculate. And then our notes receivable decreases because we increased it because we needed to receive it. Now that we received it, we got to decrease it. So we credit it. I'm just going to write out some of the more obvious entries right now. So credit notes receivable. We also know that we're going to have some kind of interest, right? So we need to kind of have a similar pattern as before when we're going to credit our interest revenue. And now here's the thing. We are now going to credit our interest receivable. This is why, because when you have interest, what it does is first you're going to debit interest receivable, then you're going to like credit interest revenue. And then eventually when the interest is paid, what happens is you're going to debit cash and then you're going to credit interest receivable. Because like the interest has been received, so we got to get rid of it. To get rid of it, you do the opposite entry. So that stuff cancels out. And essentially it's just your debit cash and your interest revenue. So this interest receivable is just for this portion. Again, this is for the right note, which according to our calculations was at $42 of interest that we need to reclaim. So this amount is just for here. This interest revenue is for the remainder of the interest that we have not already accounted for. I'll do the standard entry, then I'll like break it down into all the different interest components. But we know we have these entries for sure. And in exchange for all of this, we're given cash, so we need to debit our cash. Just for like presentation purposes, I am gonna like make it look like that. I just like having the debits and like the credits after. It does nothing like in terms of like practicality, but it just like easier to look at. So now we know for sure that the notes receivable, it has been received. We can go ahead and credit it for the original face value amount, which is $8,400. Now this interest receivable, it's not $729 because for the right note, it was for $42. So we needed to have received $42 from right. We have received $42 from right now. So we are going to credit the interest receivable by 42. And now let's look at the rest of the note. So this right note was for 3 months, right? This was for 3 months, and we have already accounted for one month of interest from December 1st to December 31st. We need to account for 2 months more. So you could just double 42 and get 84, but I'll just show you the calculation again. It's going to be $8,400 times, I think it was 6%, yeah, 0.06 times 2 months that we need to still account for, divided by the 12 months in a year, you get 84. So that's $84 worth of interest, and this is our interest revenue. Now, if you add up all of this, you're going to get 8526 for our cash. So we have been given $8,526 in cash. This gets rid of our notes receivable. This gets rid of our interest receivable, and it counts towards our interest revenue. I'm going to rewrite this exact entry in a bit more of like a detailed manner, because that helped me kind of understand the concept better. So I know for sure that I'm going to credit my notes receivable, right? I already know that that doesn't change. That becomes $8,400. And I know previously I had declared $42 worth of interest receivable, and now I have received that. So I'm going to debit cash for $42, and I'm going to credit my interest receivable for $42 as well, right? That takes care of this part of the interest. Now I know that I still need to get $84 worth more of interest. So what I'm going to do is, first, I need to declare that, hey, I need to receive interest, right? First, you got to declare it. So I'm going to debit interest receivable for $84. Then I'm going to credit my interest revenue for $84, right? This is the same as the above entry over here, except now it's just for like a different amount. So now we're going to do the exact same entry of this one for the interest that we have yet to receive. So now someone gave us the interest payment. So we are going to increase our cash by 84, and we're going to get rid of our receivable amount for $84 as well. What this does is, this entry for 42, like I know it says 729, just like pretend it's for 42. This entry and this entry make up one portion. First, we declare we need to receive interest. We count it as revenue. Then we declared that we received the interest, so we get rid of the receivable amount. This and this is the same thing as just this, except now it's just for $84. First, we declared that we need to receive $84 of interest. Now we actually receive the interest. Again, if you look at this, you're first debiting interest receivable, then you credit it. So essentially these two things cancel out, and all you're getting is just credit interest revenue, and you're getting debit cash, which we have seen here, like which we kind of saw here. This cash is for 84. It ultimately just gets added to the total amount. Cool. So now that we know our interests are taken care of, we need to take care of this credit notes receivable. Now we have already taken care of the interest payments. Now we need to take care of the actual payment for the note. So what we can do is we can just debit cash 8,400. We just separated the cash in terms of note value and the interest payment. And again, just to like make things look nicer, I'm just gonna move this cash up like over here. Cool. So now what we have is our cash for the note has been taken care of. Our cash for the interest has been taken care of. We've declared the interest and we've received the interest. So everything matches out, and all of this is just an expanded form of this. In an exam, you could just like, you could write this out, but if you can't remember this, or if you can't figure out the logic, this is a nice way to kind of work around it. I personally like using this, especially like it helps you explain the logic a bit better. But once you do enough practice problems, you will eventually kind of hopefully move on to this model. So this whole calculation, times it by, like, do it twice just for number 6 and number 7. Exact same logic, exact same entries. The numbers are just going to be a bit different. You're just going to calculate interest a bit differently. If you want to get a better example of that, then I recommend watching the in-class recording. Okay, so that was that example, and we are done. Receivables. Chapter 10, Liabilities. All right, so a receivable is when you need to get some money back. Liability is when you need to pay something to someone. So basically, if you're receiving something, the person who you're receiving from is like recording it as a liability and vice versa. So a liability is when you owe someone something, and then you have current and non-current liabilities. I forgot to explain this earlier, but current assets and current liabilities are assets and liabilities that you have to pay or receive under 1 year. Non-current is over 1 year. So let's say if you have a 10-year loan, right? The first part of that year, the first year is going to be current liabilities, and the remaining 9 years are going to be non-current liabilities. So some of the typical accounts you'll see in terms of liabilities are accounts payable. This is an account that you have to pay to someone, as accounts payable suggests. You also have accrued liabilities like wages payable, interest payable, and then you have notes payable. We worked through the notes receivable example. The exact opposite portion is notes payable. Essentially, anytime you see the word payable, like you see the payable here, payable, property taxes payable, sales tax payable, employee benefits payable. Anytime you see payable, think of it as liabilities. Cool. So notes payable is basically accounts payable, but stronger legal claim with interest. It's like accounts receivable is to notes receivable as accounts payable is to notes payable. Another common example of liabilities are sales taxes. We also have property taxes, and we also have payroll and employee benefits. So let's go with a cash register example. Let's say a company's cash register shows the following totals at the end of the day. In their cash register, they have $25,000 worth of pre-tax sales. They collected $1,250 worth of GST, and they collected $1,750 worth of PST. This is amount that does not belong to the company. They have to pay this to the CRA. This amount does belong to the company. So this is what the journal entry looks like. All of this is cash, right? Like you can physically count, like it's even in a cash register. You can physically count $28,000 worth of cash. Sorry, this is 2,800. I'm just gonna make this 28,000 credit sale. Sorry, I guess my slideshow was a bit incomplete there. But basically, when you physically count the cash, you have $28,000 worth of cash. That's your debit, right? Cash is like you have now increased cash, you're debiting cash. So GST payable, this is a liability. Remember, when you increase your liability, you have to credit it. You have to pay $1,250 to the CRA for your GST. This is a credit. You have to pay $1,750 to the CRA. Maybe not the CRA, but the provincial sales tax, and this is a liability, so you have to credit it. So now you have a total of $3,000 in your credits, and you have $28,000 in your debits. You got to come up with $25,000 worth of credits. Hence your pre-tax sales. So you're going to credit your sales, which is for $25,000. All of this amount, your debits and your credits, add up to $28K, and this is how you would record that liability. So property tax example, a company paid its property tax bill for the calendar year. The amount was $26,400 on June 30th. So I'll illustrate how property taxes work. Let's say you have a timeline of the year. You have January 1st and you have December 31st. This is June 30th, the exact middle of the year. So what the city of Edmonton does, or however property taxes work, is basically on June 30th, you'll get an amount. This amount is for the whole year of January to December. So technically, like you start off the year, everything's going fine. Then you get that big, massive property tax bill. This property tax bill, half of it is for the future property taxes that you will pay in that year. And the other half is for the property taxes that you would have paid or that you ideally would have paid previously, right? Of course, you can't really pay previously. They issue this amount halfway through the year, and this is for the whole year. So basically you're paying for the past and you're paying for the future at the same time. So that's kind of like how the timeline works. A company paid its property tax bill for the calendar year of that much on June 30th. So what's going on is you're going to first, you already know that your credit is going to be cash. Your cash is decreasing by $26,400, right? Cool. So you already know that your cash is going to be decreased. Well, you need to come up with a debit, or at least, two debits in this case. So basically, this amount when you pay on the June 30th, half of it is for an expense that you have already incurred. You are paying off an expense. You are paying off your property tax expense, right? And the latter half is basically you're paying off for the future. So your property taxes liability, you're paying off your liability right now. So it's something less you have to worry about. You're not liable for it anymore. So that's kind of like an asset, right? Where basically you got rid of your liability already, so you don't have to worry anymore. Because you don't have to worry, it's like your asset that you have taken care of your liability. So you're going to debit your prepaid property tax expense, right? You paid halfway throughout the year on June 30th. So these two debits are going to be the exact half of 26,400. So it's just going to be 13,200 and 13,200. That's the way it's going to work. All right, wages example. So a company's payroll for the month was $40,500. The company deducted the following: $2,005 for CPP, $1,000 for EI, $8,010 for income tax from the employee's pay. Whatever money the employee received, 80/10 was deducted to be given to the CRA. Also, the company's payroll costs for the month were $2,005 for CPP and $1,400 for EI. Basically, CPP is your Canadian pension plan. EI is employment insurance. Pension plan is when you grow old, you want to get money for your pension. This is where it comes from, or at least this is where a part of it comes from. Also, EI is employment insurance. You are insured for your employment. If your employment ceases to exist, you will be compensated for it. So this is kind of like basically an insurance premium, right? This is what the employee pays from their pay cut. The employer also pays a little bit of CPP and a little bit of EI for the employee. So the CPP is dollar for dollar. The employee paid $2,005. The employer also pays $2,005. The employee's portion was $1,000 for EI. EI is 1.4 times whatever like this amount will be. In this case, it's going to be $1,400. So this is essentially the calculation for that. Let's go over the journal entries. So what we're going to do is number one, we're going to have a debit of our wage expense. And this is going to be for $40,500, right? So we have a couple credits here. Number one, the most obvious credit is we're going to have a credit of cash, right? But our credit of cash is going to be a bit of a calculation. So let's work our way down. Number one, we know that we need to pay this money to the CRA, right? So our CPP payable is going to be $2,005. Same thing for EI. EI payable is going to be $1,000, right? Sorry, this is going to be your credit also. And then you also have a credit of income tax payable, right? IT, income tax, I'm just abbreviating it. And this is going to be for 8010. Cool, so now you got a couple of credits and you got a couple of debits. They don't add up. You also know that you have a credit of cash. So you just got to subtract all of these from this to get your credit of cash, which comes out to 29485. 29485. This is what it looks like for the employee's portion. Let's just I'm just gonna resize this a bit so I have some more kind of space to work with. Cool. So now this takes care of this, and the cash we paid. What about this? So what we do for this is you already know that your CPP is a credit, right? Credit CPP payable for 2005. Credit EI payable. EI payable for 1,400, right? So to add all of this up, you gotta have some kind of debit. This is just your benefits expense. This is what it's called. That's what the account is named, and it's gonna be 3405. So you got two debits here, and you got a bunch of credits. All of these, like your CPP, EI, and income tax, are payables, and you record them as credit, and you're also getting rid of your cash. By the way, like this is payable. I didn't want to write out payable. It takes too much time. Cool. So That's your wages example. Now let's look at a little bit of loans. There are two kinds of way to pay off a loan. Number one is your fixed loan payment. We're going to be going over fixed loan and blended note. The example remains the same. A company borrows 120K for 5 years at 7% interest. Same for both examples, right? Except with a fixed loan payment, the principal will be paid back $2,000. So with a loan, there's two portions to it. You have the interest, which is basically like your service fee for borrowing the money, and then you have the actual loan, which is like the actual money that you borrowed. You got to pay both of those back. With a fixed loan, you're paying consistently $2,000 of the principal. So let's say you got a loan on January 1st, right? Well, you don't really have like any payments till then, so your principal balance is 120K. What you do is on February 1st, you pay back $2,000 from your principal balance. Now your principal balance is 118K. And this interest that is calculated is you take 7% of this amount of 120K. And again, this is for 1 month out of the 12 months. So you times it by 1 over 12. This amount, 700, is like 120K times 0.07 times 1 over 12. Cool? So you are already paying 2K for your reduction of principal. Now you got to pay 700 for your interest expense. You add these two up, you get 2,700. That's awesome. Now you know that your new principal is 118K. I want to make it very clear that this 118K is derived by reducing the principal by 2,000, not by 2,700. This is interest. This does nothing. This is like an extra payment. So now your new interest for the next month is going to be 118,000 times 0.07, because it's 7% interest, times 1 over 12. That's $688. And then you're every single month you're paying $2,000. So this gets added together. You are cash paying 2,688, and then the next month you're gonna have a principal balance of 116, then so on and so forth. I'll draw a quick summary here. This is equal to this plus this. This minus that is equal to that. Do that for every single line, and that's how it works out. If you have extra time, make like an Excel document when you just like kind of carry this forward until the interest is paid. It just helps me visualize it. All right, now let's look at a blended loan payment. So here we were consistently paying $2,000 to reduce the payment monthly. Now we pay a fixed amount no matter what. If you look at the first example, every month you're paying a little bit different amount of money. Here you're paying the same amount of money no matter what. So this is a little bit better for kind of planning and budgeting, because now you know for sure that I need 2,376 in my bank account if I want to make my loan payment. So how this works is the first calculation is pretty simple. So, well, first you need to understand that every single month this number will be given to you. You will be paying 2,376. So the first calculation for interest is the same as before. You take your 120K, times it by 7%, times it by 1 over 12 to get 700 interest. Now you know that you're going to be paying this amount no matter what. So exactly how much is your principal reduced by? Well, it's going to be reduced by the total amount you paid minus the amount for interest is the reduction of principal. So now your 120K is going to be subtracted by 1,676 to get the new principal balance. Now the next line, this is the same, so don't worry about that. Now next month you're going to pay this much interest. Why? Because it's 118,324 multiplied by your 690, multiplied by your 7% times 1 over 12. And then you keep on doing that for your interest payments, and then for your reduction of principal. Your reduction of principal will get increased every single month, and your interest expense will become decreased every single month. Your cash payment is the same every single month, and your principal balance, of course, will get decreased every single month. So that was like fixed and blended. I recommend going over the in-class examples for this. It helps you understand the concept better. And now this is in-class 10.4. I'm not going to spend too much time going over this, but basically this is like you being given a loan amortization schedule. This is basically like this table expanded out until the total amount of the loan is equal to 0. And then this is called your loan amortization schedule. So the question asks, what are the amounts related to the loan that would be classified on the balance sheet at December 31st, 2020 in the current and non-current sections. So this loan was issued on December 31st, 2019. And we have semi-annual payments for June 30th and December 31st, right? So this is the issue date. This is December 31st, 2019. Sorry, I'm butchering my words here. But your principal balance is 50K, right? So at December 31st, this much has already happened. You don't need to worry about that. That's already happened. So in your current liabilities, current is 1 year. So what is 1 year for this portion? Well, 1 year is going to be up until June 30th and up until December 31st of 2021. Basically, all of 2021 is going to be current. And all of your long-term liabilities is going to be this plus whatever it might exist. So you're going to break off the loan amortization schedule by your current and long-term to answer the following questions. Again, if you want more practice on this and if you want a better explanation, you can watch the in-class recordings. I just went over a quick brief introduction though. So I am going to go over bonds. It's a really confusing concept, but just know I'm getting to it. However, I'm going to quickly go over some ratios first. Number one, debt to total assets. This is the proportion of a company's assets that are financed by debt. As in, for every asset you have, how many total liabilities do you have? Ideally, you want a lower value than a higher value, because that way this value is less than this value. Or ideally, that's the desired case. So times interest earned ratio. This is basically your ability to make interest payments on long-term debt. Whenever you get a loan financed, the bank wants to know that you were able to pay back the money that you get from them. So to do that, you need to have your earnings before interest and taxes divided by your interest expense. If you look at your income statement, I'll actually pull that up right now. This is what an average income statement looks like. You have your revenues minus your expenses equal to your profits. Then you have some more categories of expenses, but essentially it's your sales revenue, which is your sales minus the sales returns and allowances minus sales discount. This equals to your net sales. If you subtract your cost of goods sold, you get your gross profit. And then your operating expenses are like salaries, insurance, etc. So when you subtract your operating expenses from gross profit, you get your earning before income and taxes, right? Here we have some interests and here we have income taxes. At the end of all of those, you get your net income. So this is what you want to calculate the ratio that we just covered. So either if you have this value, that's awesome. If you don't have this value, you can just take your net income, add in the taxes, add in the insurance, and get to your EBIT. Right, this is also shown here. If you have your EBIT value, awesome. If you don't have it, take your net income, add in the interest expense, and add in the income tax expense. And all of this is divided by the interest expense, which tells you your ability to make interest payments on long-term debt. So uncertain liabilities, there's 4 scenarios. Let's say, so basically what an uncertain liability is that businesses get sued all the time. They need to be able to record for it. So if you know that someone is suing you, but it's so ridiculous, it's frivolous that it just won't go to court, you don't need to do anything because you know it's not going to happen at all. So no entry needs to be recorded. Next up, if you know that a lawsuit is likely and you can measure it, then you record it. So you're going to debit legal expense and you're going to credit litigation liability. This entry is the same for all the future examples. It's just the way we kind of, the amount changes. So if it's likely and measurable, we record it. This is what the recording looks like. And when you actually pay off the liability, you're basically getting rid of the liability. So you debit it and you are getting rid of cash to pay off. You don't need to worry about this, but this is essentially what the recording of the entry looks like. This is for likely and measurable. What if a lawsuit is likely but not measurable? So we can't measure it. We're not going to record it, but we are going to add a note to the financial statements that, hey, something's going on, just to be wary of that there might be a potential lawsuit. And if the lawsuit is likely and there is a range of measurements, like the lawsuit can either be 20 million or 60 million. Well, we're going to record it and the number is just going to be the average of the ranges and expense. So let's say over here, if it's likely and measurable, like we know it's for 40 million, we're just going to record it as 40 here and 40 here. If it's a range, like it's either between 20 or 60, then we're just going to average it out, and 20 plus 60 equals 80, divide that by 2, 40. Cool. So ratios and liabilities are done. Now let's go over bonds. So a very quick summary of bonds. A it's basically an interest-bearing loan, typically used to generate money for funding. So there's two types of ways to generate money. There's debt financing and equity financing. Bonds are a way of debt financing. So there's two kinds of rates whenever you see a bonds question. Basically, people buy bonds because a company sells bonds because they want to issue money, right? Sometimes banks just won't give you money, so you sell bonds to the public. And people buy bonds because, hey, if you have $100, you want it to be more money by the end of the year, right? You do this through interest payments. So you invest that money, and bonds serve as a good way to invest money. There are two kinds of interest rates. Number one is the market rate, and number two is a stated rate. The stated rate is whatever the bond offers. For example, you have a $1,000 bond at 10% interest. The stated rate is 10% interest. The market rate is if you were to put that money in the bank or just the general market, what money would you generate? In my example, I have 8%. So picture this. So you are looking to invest $100. You could put it into the market rate, which let's say it's 10%, or you could put it into a bond. Let's say it's 8% hypothetically. So if you put it $100 into the market, you get back $110. If you put $100 into the bond, you get back $108. So the company needs financing, and the customer could clearly get better return in the market. So the bond needs to be issued at a discount. So instead of buying the bond for $100, the company is going to be like, hey, in order to incentivize you to buy my bond, instead of $100, you can buy it for $98, and you're still going to get back the $100. This is called a discount bond. The exact opposite is called a premium bond. For example, let's the market rate is 8% and the bond is 10%, right? If a person puts $100 into the market, they get back $108. If they put it into the bond, they get back $110. The bond's like, hey, you know what? My rate is way better than the market. You should invest with me, but it's going to cost you a bit expensive because it's like that. The extra 2%, consider as a service for buying the bond, service fee. So the bond, instead of being $100, it's now going to be something like, I don't know, $102 or like $103 or whatever. And in this case, the bond would be issued at a premium. So let's say if we have $1,000 bond at 10% interest and the market rate is 8, right? So the market rate is less than the stated rate. A person gets more interest buying into the bond than they do from the market. Would the price be higher or lower than $1,000? Answer is already given for you. It would be higher because now the person can like, now the person is buying the bond for a premium because the bond gives them a higher interest rate. So what's going to happen is that the person will buy the bond for 1035.67, and they will get back $1,000 from the bond plus whatever like the interest is. But like at the end of the day, the goal is to reduce this extra $35 into $1,000. Cool. So let's talk about issuing a bond. So when you're issuing a bond, you're a company who wants financing. You want your cash to increase. So what's going to happen is, in all of these situations, we're going to issue $1 million bond for 5 years at 5% interest. So your cash is going to go up by $1 million, and your bond payable is going to go up by $1 million. Your bond payable, again, payable liability. This is something that you owe to your bond buyers, and this is going to go up by $1 million. So let's say if you have like the bond at 100%, right? It's just going to be debit cash 1 million, credit bond payable 1 million. Now let's say if you issue at a discount. So again, discount is when the market rate is greater than the stated rate. So now you're going to issue it for 98, and you're still going to pay them back 100 at the end of the day, but don't worry about that now. So it's issued at 98. So think of the 98 as like a 98%, and you multiply this by 1 million, so you get 980K. The rest of the debit cash credit bond payable, that's the same, just the number changes. It's at 98% now, 98% of $1 million. And now when you issue at a premium, same concept. Instead of 100 though, you're at 105 because the market rate is less than the stated rate. So think of this as 105%. So it's basically 1 million times 1.05. So your cash is increasing by 1.05 million, and your bond payable is increasing by 1.05 million. So amortization explained. So looking at stuff like this, right? Your bond is worth $1 million in both cases, in all cases. In this case, you're issuing your bond at a discount. So your bond payable is 980K. It should be 1 million. So you gotta come up with an extra 20K of bond payable. in this case, your bond is worth $1 million, but you gave it away for 1.05. So you gotta essentially find a way to decrease this, right? That's what amortization is. With discounts and premiums, the bond purchase price differs from the face value, right? Purchase price, face value. So depending on if it's a discount or premium, we have to add or decrease the value of the bond to bring it back to face value. For example, I just ripped this off straight from the previous slide, but in this case, our bond payable is $980 at a discount. We need to increase the above to 1 million. So we got to come up with an extra 20K worth of bond payable. And I'll be teaching you how to do that in the next couple of slides. The opposite scenario is when you issue a bond at a premium. In this case, let's say your bond payable is at 1.05 million, and you need to decrease this somehow to 1 million. The somehow is through amortization, which again I will explain. So there's two ways of amortization. Number one is straight line. So you take the discount and premium amount and you divide it by the number of terms. So let's say if like this is for 5-year bond, right? Let's say interest is paid every year. So if you want to come up with 20K over 5 years, then every year you got to come up with an additional 4K, right? And that additional number will be added or subtracted, again, depending on discount or premium, to the bond payable amount each term. Next up is the effective interest rate, where we have a portion of the interest that changes every term since the bond payable amount is changing, right? This is the preferred method because it represents the cost at a more kind of accurate level. And again, this is added or subtracted depending on the discount and the bond to the discount or the premium to the bond payable amount each term. So best way I can explain this is just through an example. And I'll pull up my slideshow right now. This example, I'm just going to be going over my pre-written entries. I'll be explaining them along the way. So we're a company, we issue $1 million worth of bonds at 10 years and 5% on January 1st, 2021. The market rate is 6%. So stated is less than market. Customer could get more in the market. We need to incentivize them to get more here. So we're going to offer them the bond at a discount. And the interest payable is semi-annually on July 1st and January 1st. So we have a December 31st year end. And this is relevant because if we need to pay interest on January 1st, at some point we're going to have an interest payable. Usually it would have been just debit interest expense, credit cash. But now we have an extra step of debit interest expense, credit interest payable, debit interest payable, credit cash. This December 31st is the reason we have that little extra step. Cool. So required one, record the issue of the bonds. Again, plain and simple, debit cash for 9/25/6/17, credit bonds payable for 9/25/6/17. And this is the date that they were issued. Required two, record the payment of interest on July 1st. Okay, so here's the tricky part. Let me pull up my calculator. Cool. So now that I have a calculator, what we need to determine is exactly how much the person would have received had they put it into the market. So had it put it into the market versus the bond. So we know for sure that the bond is going to give a 5% interest rate, right? And interest is accrued semi-annually, so 6/12, like we're going to accrue interest every 6 months out of the 12 months in a year. So how that works is we know our bond is worth $1 million. And we need to times it by 5% interest, 0.05. And we need to times it by 6/12, right? We get total semi-annual interest of $25,000. That is the amount of cash that we as a corporation has to pay to our investors. We already know that. That is credit cash, 25K. That will not change. In fact, that will never change in any of the scenarios. Cool. So now that we know that's how much we will have to pay, we need to determine exactly what the customer is missing out on. So we know that the market would return 6%, but the bond returns 5%. So we need to, and because we incentivized them, we offered it at a discount. So we need to increase this amount to 1 million somehow. We're going to do that through amortization. So basically we need to determine what the person would have received had they put that money into the market. So the person is only investing 9/25/6/17, not 1 million. So this is the money that we're going to use for that calculation. So if that person, and when I say person, it's like a bunch of people who buy the bond, but for our scenario, we're just going to like simplify it a bit. Let's say the people put their $925,617 into the market, which had which would return 6%, and times this by 6 over 12 because we want to like compare apples to apples. So we're gonna times it by semi-annual. They would have returned 27,768. For my purposes, I just rounded it to 27,769. Again, just like it doesn't matter. But this is basically what the person would have gotten had they put it into the market. But with us, they're only getting 25,000. So they're losing out on $2,769 worth of value. That is how we're going to increase this 925K to 1 million K. We're going to do this calculation every single reporting period or every single term, and we're going to add this amount, 2769, to the bond payable. So you know that the interest expense is 2769 because we calculated that. The remaining discrepancy, this is the amount that gets added to bond payable, right? We need to increase our bond payable to this, so we got to add stuff to it. The stuff that we're adding is equal to the discrepancy between the market rate and the bond rate. Cool. So that's number 2. I would recommend rewatching my video I would recommend rewatching that part of the video because it's a bit of a complex topic. And then required 3 is record any entries for the company's year end, December 31st. So basically we're accruing interest. So essentially the exact same thing. However, there's something that we need to take care of. So our bond payable increased by 2769. That means it's no longer 925,617. So we need to actually increase it. So we're going to add 925,617. So now our actual bond payable amount is $928,385.51. In the future, whenever we calculate that interest, like times by 0.06 times 6 over 12, we're going to do it over the 928K instead of the original 925K. So to do that, actually, I'll just do it right now. So if we were to do it for required 4 times this by 0.06 times 6 over 12, now our interest expense becomes 27851, and our in this case it's going to be an interest payable because we're actually paying the interest on January 1st, but on December 31st we need to accrue the expense. So instead of just getting rid of our cash, we just got to like record it as a payable instead. It's the same 25K, that doesn't change. And this is like our discrepancy now. So minus 25,2851. This is our bond payable amount that gets increased by. And again, now our new bond payable becomes this amount plus the old balance, which if you remember was 928K. 385.51. Again, for the future term, this becomes your new bond balance. Don't worry if this is confusing. I'm like right after I'm done this example, I'll be switching over to a Google Sheets where I kind of explain the whole concept again. So this is our second part of the entry, and now we actually need to pay off the payable. So when January 1st rolls around, we're just gonna get rid of our payable and we're gonna substitute it with cash instead. That's the entry. So this is for a discount bond. For a premium bond, let's say if the market rate was 4% instead of 6. So now the market returns 4, the bond returns 5, the bond returns more, so we need a premium. So the premium is going to be 1,081,757. Literally the exact same concept, but instead of our debit credit, we're going to have a debit credit. Basically, we know our cash is always going to be 25K no matter what. We need to now decrease our bond payable amount because we need to decrease 1.081 million to 1 million. To do that, we need to decrease it, and to do that, we're going to debit bond payable. So in order to calculate this, I'll just go over this quick example. Had the person put 1,081,757, this number, into the market, they would have gotten 4% times 6 over 12. So that's the amount of interest they would have gotten. We're paying them 25K, so minus 25K just to calculate the difference. Basically, they're losing out on $3,364 worth of interest by going to the market versus choosing our bond. Therefore, we're doing them a favor, we're doing them a service, so we need to decrease the bond payable, which becomes our debit. Same exact concept as before. This amount now gets reduced from our bond payable, 1081757. So our new bond payable amount becomes 1,078,392. Our new calculation for the next term is based off of this new number, 1,078,392, and the payable concept remains the same. So I'll be going over this now on a spreadsheet, which will make much more sense. So I'll be going over this now on a spreadsheet, which will make much more sense. All right, that was chapter 10. Let's go on to chapter 9, depreciation. So a quick recap of depreciation. We're basically talking about long-term assets here. These are property, plant, and equipment. Property is like the actual land, plant can be buildings, and equipment is just like factory equipment. That's probably the easiest example I can give. And so basically, we buy these things, right? We buy them at a specific cost. That cost is the purchase price plus the expenses needed to make the asset ready to use. For example, in terms of land, to actually use it and to actually legally own it, you have a bunch of legal fees, permits, whatever, right? The purchase price of the land is going to be the purchase price plus all of these legalities. For example, for buildings, it's going to be the purchase price plus legal fees plus permits, architect's fees, whatever you might have. Same with equipment, it's going to be like purchase price, freight charges, assembling, etc. And then so we need to record their cost at relative market valuation. What this means is basically you have a group of assets together for a different price. You buy these together for a different price, then they are valued. For example, someone is selling a bundle of land, building, and equipment. It is valued at $800,000, but they sell it to you for $600,000. So this is, for example, right here is what you bought it at. So you bought $800,000 worth of PPE, you bought $160K worth of land, you bought $400K worth of building, and you bought $240K worth of equipment. So all of this stuff totals up to $800K. Now, you bought it for $600K. You bought stuff valued at $800K for $600K. So you want to determine exactly what percentage of the $600K is for the land, building, and equipment. So what you're going to do is you're given this and this. You can divide $160K by $800K to get 20%. As in 20% of the money you spent on the $800K was for land. 50% of the money you spent on the $800K was for building. 30% of the money you spent on the $800K was for equipment. Now you have the relative percentages, right? Hence the relative. And then you can multiply these relative percentages by the actual total cost of what you purchased them at. In this case, we take all of these percentages, times it by 600K, and then that results us to the actual value. So the allocated cost is basically we bought $160,000 worth of land for $120,000. This is the price that we record the good at. And so whenever we have these long-term assets, essentially assets wear down, they become less useful. This is called depreciation. There are 3 methods to calculate depreciation. Number 1 is straight line, number 2 diminishing balance, and number 2 is the units of production. So residual value is basically the estimated life of an asset at the end of its useful life. This is how much you can sell it for after completely wearing it down, after it's pretty much good as nothing. So residual value is never negative. So residual value is never negative. It is either 0 or positive. As in, you can't wear down an asset to a negative extent. As in, let's say you bought something for 100K, you can't wear it down past 100K. The residual value must either be 0 or greater than 0. So depreciable cost. This is the total cost of the asset that you can write off, the total amount of the asset that can be worn off, basically. So it's the acquisition cost minus the residual value. Each asset will have a different residual value. Sometimes they might be grouped together, like buildings might last a certain bit more than certain kinds of equipment, etc. Either way, this will be given to you in a question. This is what you're going to have to calculate. This will be either given to you or you're going to have to calculate it through this method. So depreciable cost, we already understood that. And explaining depreciable cost in words is that this is the total value that an asset can lose it's equal to how much you bought it for minus how much you can sell it for after it's pretty much totally useless. So an example layout. So we're going to be using this example for the following 3 lines of depreciation costs. So let's say we buy a van for $33,000. Let's say the estimated residual value is $3,000. So its useful life in years, let's say we determine it to be 5 years, and its useful life in kilometers, let's say we determine it to be 100,000 kilometers. So straight line depreciation. I just took this example, I just put it in the top right corner for easy access. So first we need to basically determine the depreciable amount, the total amount of dollars that we can write off for depreciation. So this is the cost minus residual value. We bought it for $33,000. We have a residual value of $3,000. That means the total depreciable cost is $30,000. Now we need to determine the annual depreciation expense. So with straight line depreciation, you could literally visualize it. It's basically just a straight line. It's linear, as in after any given year, you will be depreciating the same amount. So the way it is the total depreciable amount divided by the useful life in years is the annual depreciation expense. For example, we have a depreciable amount of $30,000 that we calculated in the last step. We have a useful life of 5 years as indicated in the question. If we divide 30 grand by 5 years, we have $6,000 of depreciable cost per year. And so the entry with this would look like debit depreciation expense, because with expenses you debit them to increase them, and this would be of $6,000, and your credit would be for accumulated depreciation. So accumulated depreciation, which going forward I'm just going to abbreviate it as AD. This is a contra asset account. Let's say you have a $100,000 building, and this is like your long-term asset, right? And then beneath this, it would say accumulated depreciation for building. And let's say you've total that the depreciation for this is, let's say, 20 grand. So that means the net carrying value of building would technically be $80,000. The building accumulated depreciation is just a contra asset account that reduces the value in the asset account. So you need to prorate this for the year. So let's say if you bought this car on May 1st and the year end is December 31st, you've technically only used the car for 8 months in the first year. So therefore you take the annual depreciation expense, which we calculated to be $6,000, and you multiply it by the total amount of time you used it in a year. In this case, you used it for 8 months out of the 12 possible months in a year. So it becomes $4,000 of depreciation expense that you can write off. This is straight line depreciation. Let's go on to diminishing balance. So with this, you essentially have the assumption that assets depreciate faster towards the start of their life as opposed to less when they're close to the end of their life. For example, on a curve, it would look something like this, because let's say after year 1, you've depreciated like so much value. But let's say after year 2, you've only depreciated a little bit. After year 3, even less than that. And so the way it works is you need to determine the straight line multiplier. In our example, we determined that the useful life was 5 years, and the straight line multiplier is basically 100% divided by the useful life. In this case, it's 100% divided by 5 years, meaning we have a straight line multiplier of 20% per year. So the depreciation rate that we calculate is the straight line rate multiplied by the multiplier. So sometimes you have a multiplier, sometimes you don't. This is usually given in the question. So in this case, remember in straight line depreciation, we have to calculate the residual amount, so residual value. And here you do not include residual value in the calculation. The only exception is that you are not supposed to depreciate past residual value. So for example, the way it would work in this case is, let's say the multiplier is 2. We are given this in the question. In this case, I just made this question up. So we know that our straight line multiplier is 20% per year, 20%, and our cost is $33,000. So we're going to multiply this by $33,000. And then we have a multiplier. In this case, the multiplier is 2. So we're going to multiply this by 2. So in this case, our depreciation expense would be uh, 0.2 times 33000 times 2. In the first year, we would have a write-off and a depreciation expense of 13200. And again, like For this, you would just debit depreciation expense, credit accumulated depreciation, except now it's just of this value. And then now our total depreciable value becomes 33,000 minus 13200. And for this, you get an answer of 19800. This is your total depreciable value at the end of year one, at the start of year two. So now let's say for year two, again, we use the 20% times the 19800 times 2 equals, your second year depreciation would be 7920. You would keep on doing this. Eventually, at some point, you're going to get a value that is less than the $3,000. That is incorrect because we cannot depreciate past the residual value as highlighted over here. Again, for this, you want to prorate this for the year. So let's say, just going back to our year one example, in year one, you could depreciate a total maximum of $13,200. Again, let's say you bought this on May 1st, so you only used it for 8 months, then you would just take this amount, multiply it by 8 out of 12 to get whatever value that comes out to be. Lastly, we have the units of production. So first for this, we do need to determine our depreciable amount. We've calculated this before. It's just your cost minus residual value. In this case, 33 grand minus 3K equals $30,000. So the depreciable amount per unit is equal to the depreciable amount divided by the estimated total units of activity. In this case, we're talking about a car. Cars operate in kilometers. And we need to calculate how much we can depreciate per kilometer driven. In this case, it's $30,000 divided by 100,000 kilometers equals 30 cents a kilometer. So for every kilometer that van drives, we are allowed to depreciate 30 cents off of the total asset value. And this is estimated total units of activity. Maybe if you're talking about, I don't know, a laundry machine and you define total units of activity as the amount of cycles a laundry machine can run. This is talking about cars, so we talk about kilometers. It just depends on a case-per-case situation. So the depreciable amounts times the units of activity during the year is a depreciation expense. Let's say you drove the van 15,000 kilometers in the first year, then the depreciation expense is that amount of kilometers multiplied by 30 cents a kilometer to get 4,500 kilometers. $4,500 as a depreciation expense. And again, the entry for that is debit depreciation expense for 4,500 and credit accumulated depreciation for 4,500. So in this case, you do not need to prorate since it's not per year, it's per unit. In the first two, you do need to prorate. In units of production, you do not need to prorate. So let's talk about disposal of assets. So for this, we need to calculate the carrying amount. So this is basically the cost minus accumulated depreciation. Basically, it's what the asset is worth right now. In this case, in back to our straight line case, for example, we know that our cost is $33,000. And in year one, we depreciated $6,000. That means after year one, our calculation is $33,000 minus $6,000 to get $27,000. And that is what we're going to use for the carrying amount. And then after that, we sell the asset because if you dispose of it, you want to sell it. And so here's kind of like the logic part. If you sell more than the carrying amount, it's a gain. Otherwise, it's a loss. So I'll use actually the example I have on my screen right now, where let's say we bought a van for $30,000. It's depreciated $10,000 so far. So we need to determine our carrying amount. It's going to be $30,000 minus $10,000 equals $20,000. That's our carrying amount. So let's say scenario one, we sell it for $25,000. Well, the entry for that is, we already know that our proceeds, 25K, is greater than the carrying amount, 20K. So we know we're going to have a gain. We already know we're going to have a credit for a gain on sale, and the amount, we're going to calculate that. So you sell something for $25,000. Someone gives you cash for $25,000. You already know that that is a debit in cash for $25,000, right? And you know that it's worth $20,000. So in your balance sheet, you're going to have an account. Let's say it's just called truck. In this case, the truck value would be $20,000, right? That's the net carrying value. So when you get rid of the truck, you're getting rid of this asset value, right? You're getting rid of this asset account. And in order to get rid of an asset, or in order to decrease an asset, you credit it. So you know you're going to credit your truck account by $20,000, right? So over here we have $25,000 worth of debits, and we have $20,000 worth of credits. So we need $5,000 worth more on credits. So we have a $5,000 gain on sale. And this logically makes sense. I have something worth $20,000. I sell it for $25,000. Logically, I made $5,000 on that sale. Similarly, let's say we sell it for $15K, right? So the debit part remains the same. We have a debit cash for $15,000, right? And we know that we got rid of our truck, right? So we're going to credit our truck for $20,000. So basically now we have $5,000 more in credit than we do in debit. So we need $5,000 of debit. And in this case, we need to debit something because we need to come up with an extra 5K. And here it's going to be a loss on sale. Logically, this makes sense because you have something worth 20K. You sell it for 15K. You lost out on $5,000. Therefore, it is a debit and it's a loss on sale. All right, let's talk about intangible assets. So for PPE, property, plant, and equipment, it's called depreciation whenever it loses value. For intangible assets, it's called amortization. Effectively, it's the same thing. It's just a verbiage difference. So for intangible assets, it's called amortization. There's two kinds of intangible assets. One with a finite life, for example, a patent or a copyright. Patents are usually done per year. Let's say if you have like a patent for a new technology and it's like you can use it for the next 10 years and you bought it at 100K, then effectively like your amortization cost per year is the 100K divided by 10 years equals 10K per year. This is with finite life, and the amortization is very similar to PPE. It's recorded the same way, but you only use straight line depreciation because this is basically something that's intellectual property. There's no way it can depreciate like this. It can only depreciate on a straight line method. It loses the same amount of value every single year. Next up, we have indefinite life. So an intangible asset that has an indefinite life. For example, trademarks. For example, goodwill. So these are not amortized at all. Instead, each year you test for impairment. So let's say your company bought another company and that company increased your company's goodwill by $80,000, but next year that is only worth $70,000. Well, then you would decrease the goodwill amount by $10,000. So I'm going to go over some ratios here. Number one is asset turnover. It's basically how efficiently a company uses its assets. So for example, it's the net sales divided by the average total assets. And what this means is like you were given a balance sheet and then you would have a balance sheet for 2 consecutive years. You would calculate the total assets for both of them, add them up and divide them by 2. And then this is divided by the net sale. And then the net sales is divided by that number. And it calculates how many dollars of sales does $1 worth of assets produce. And then next up we have a return on assets. This is the total net income generated per dollar of assets. In this case, in both of these cases, you want ratios that are higher than lower. And this is your net income divided by average total assets. Okay, so that's the end of chapter 9. We're going to move on to chapter 11, shareholders' equity. So a quick recap. Companies issue shares to raise capital. This is called equity financing. They can also issue bonds. That's called debt financing. But in this case, we're only going to focus on equity financing. To issue shares, you have to debit cash because the cash increases, and your common shares, that amount also increases. So basically, you're giving out let's say 500 shares, right? And you're giving out $1 per share. So your cash is increasing by 500, and your common shares are also increasing by 500. So the shares are recorded at fair value. So let's go over reacquisition of shares. A company can buy back some of the shares that it issues. So there's 3 steps to do this. Number 1, you decrease the number of shares based on the average cost of shares. And the average cost of shares is calculated using this formula. It's the total amount in dollars of the common shares that you have divided by the number of common shares. So it basically gives you an average cost of the shares in your common shares account. Next up, you need to record the cash paid. So when you are buying back some of the shares, you are paying cash in exchange for the shares. So you need to record that credit of cash. And step 3, you need to record whether it's a gain or loss. If you buy back shares for more expensive than they were when you issued them, it's a loss, and vice versa if it's a gain. So let's go over exactly what these 3 steps do. So number 1, we need to decrease the number of shares based on the average cost of shares. So in both of these cases, the company issued the shares at $2 per share, right? And let's say the company wants to buy back 5,000 shares. So in the first one, they're reacquiring the shares at $1.50. So what we need to do is first we need to decrease the amount of common shares that are available in circulation. This is because the company is buying them. To do that, we debit by $10,000. This is our debit column, and then this is our credit column. So common shares, we're buying them back, so we're decreasing them for the shareholders, so we need to debit them, and we're debiting a total of $10,000 because we are buying back 5,000 and we issued them at $2. So next up, we need to record the cash paid. Don't worry about this, we'll calculate this in the next step. So we are buying back 5,000 shares at $1.50 a share. So if you multiply these two, we're effectively paying $7,500 in cash, so our credit cash, for 5,000 shares. Now, if you remember, we decreased the shares by 10,000, but we only paid $7,500 for them. That means we need to add $2,500 in our credits just for these 2 columns to balance out. And then this correlates to your contributed surplus. This is an account. It basically calculates like whether it's kind of like a gain or a loss almost, but for your reacquisition of shares. This is like the step 3 that we calculate. So in this case, you would have a credit balance of your contributed surplus. So next up, let's say we reacquire the shares at $3 instead. You can already see we issued them at $2, but we're acquiring them at $3. So again, let's do the same calculation. It's the same for the first 2. Step 1 is the same. So we are decreasing the amount of common shares in circulation by $10,000 because we want to decrease 5,000 of them that we issued at $2. And then next up, we know that we're paying $3 per share, so we can do 5,000 times 3. We know that we are crediting cash by $15,000. We already know this is going out of our pockets. So now we have a discrepancy of $5,000 that we need to come up. So the first step you do, this is step number 1, is your contributed surplus. First, you would see if you already have some kind of a credit balance in your contributed surplus. In this case, we do. By the way, these entries are just like consecutively right after each other. That's just the scenario I've provided. But in this case, we already have a credit balance of $2,500 in contributed surplus. So we can debit that amount, right? You cannot debit more than the amount in contributed surplus. Contributed surplus is either 0 or a credit balance. It's not a debit balance. And then, so that's only $2,500, but we needed $5,000. So we're going to use $2,500 out of our retained earnings. This is directly coming out of the income of the corporation. All right, so that's reacquisition. Now let's go over dividends. There are 3 types of dividends. There are cash, stock dividends, and stock splits. So let's go over cash dividends. Well, number 1, let's go over what a dividend is. It's basically a reward given to shareholders for owning shares. When you own shares of a corporation, the goal is that you make money, and the way you make money is either through cash dividends or more shares, right? You either get cash or you get more shares. Cash is usually the most common form of dividends. It's usually just a percentage of the stock price. It's usually just a percentage. So to issue cash dividends, you must have the following 3 criteria as must. Number 1, you must have retained earnings. If you have negative earnings, then that means you do not have enough cash to give. So where are you going to get the cash from, right? Number 2, you actually must have enough cash. Like if you want to issue $100 worth of dividends, but you only have $80 in cash, then you can only issue $80 worth of dividends. And also, dividends must be declared. So you can't just like give it. First, you have to declare a dividend, then you have to pay off the dividend. Like there's going to be 2 entries. So there are 3 dates when it comes to dividends. There's a declaration date, which means the board of directors declares a cash dividend. This is a legally binding obligation. Next up is the record date. There's no entry required. It just determines who gets the dividend. And then the payment date is when the dividends are actually paid out. For example, here you would have like a debit, dividend, expense, credit, dividend, payable, and then in the payment date, you would have a debit, dividend, payable, and then credit, cash. Like that's the actual just transfer of the dividend. So a stock dividend is that instead of giving the shareholders cash, you just give them more shares in the corporation. What this does is it satisfies the shareholders because they're still getting some value. And right now, let's say if you do not have enough cash to offer a cash dividend, you can just issue a stock dividend because you don't need cash to do that. So an example is, let's say a company has 10,000 shares and you own 200 of them. So you own 2% of the corporation. They give you a 10% stock dividend. So what that does is the company issues 10% more shares based off of the 10,000 shares they have. So the company issues 1,000 new shares, and out of those 1,000, since you own 2%, you get 20 of those. Because you owned 200 shares before out of the 10,000, you total owned 2%. Now you own 220 shares out of the total 11,000, which means you still own 2%. So your equity doesn't change. It's just the number of shares you own increases. So the entry for this would look is, to declare the dividend, you would have a debit stock dividend, credit stock dividend payable. For distribution, you would have the debit stock dividend payable, credit common shares. So essentially, you're kind of canceling out this transaction. Lastly, we look at stock splits. So this is when you issue additional shares based on percent ownership. So let's say a company has 1,000 shares with a total value of $5,000. That means there's the value of $5 a share. They do a 2-to-1 stock split. Now they have double the amount of shares because it's 2-to-1. So now they have 2,000 shares with a total value of $5,000. The value doesn't change. Now it's $2.50 per share. There is no journal entry for this because it's just a stock split. Let's look at the impact on retained earnings for each of these items. So for a cash dividend, let's say before you had $500K in common shares, after that you still have the same amount. With retained earnings, you had $300,000 previously, but because you paid cash, you were reducing the amount in your retained earnings by $25K. And in all of these examples, we're just assuming $25,000 worth of dividends are paid. Well, except this one, and you'll see why. But what this does is, before you had a total shareholders equity of $800K, because this is common shares plus retained earnings, but now after you have a total shareholders equity of $775K, because you lost $25K due to the cash dividend. Next up, we look at our stock dividend. So before you had $500,000 in common shares, now you have $525K in common shares. This is because you issued more stocks as a dividend. This increases the amount of common shares, and thus it increases the dollars in common shares. And in order to get this $25K, you gotta decrease it from somewhere, right? So you decrease this from your retained earnings. This makes your retained earnings less by $25,000. However, in this case, you're just moving money from here to here. So at the end of the day, the total shareholders' equity remains the same. Lastly, let's look at a stock split. Before the common shares amount was $500K, it's still $500K now. Before the retained earnings was $300K, it's still $300K now. Before the total shareholders' equity was $800K, before the total shareholders' equity was $800K, now it's still $800K. I know it says $300K, that's a typo. So now let's look at the statement of retained earnings. Statement of retained earnings is for ASPE. All it does is you take the retained earnings, you have the opening balance of it, you add in the net earnings, which is basically revenues minus expenses, and then you subtract dividends, either cash or stock, and then if you acquired any common shares where the price to reacquire is greater than the average cost, which means, like, if we go back to our example, which means like if retained earnings would decrease, then you would have that figure as well. This equals your retained earnings ending balance. This should be the same on your balance sheet that is given. Next up, we have the statement of shareholders' equity. This is for IFRS. For IFRS, they can use this one and this one because this one calculates retained earnings. This one calculates shareholders' equity, which, retained earnings is a part of that. But an ASPE company would never have this. They would only have statement of retained earnings. So let's look at what this is. Number one, you need the who, what, when. So this is the corporation, this is what, this is the when. And this is for a period in time. So it's for the year ended, not at year end. And then what it consists of is you have your opening balance and the date. So you have the opening balance for all of the equity accounts. You have retained earnings, common shares, and contributed surplus, which if you remember, it's basically this figure, which is either the gain or the loss when it comes to reacquisition of shares. Cool. So next up, you would have various entries. Let's say if like they issued a cash dividend, that would decrease your retained earnings. It does not affect your common shares or your contributed surplus. Let's say if they decide to issue a stock dividend, you would kind of record that entry where it would decrease the retained earnings and increase the common shares by this same dollar amount. And total, the net change is 0. So the total in the rows is the sum of the rows, and the total in the columns is the sum of the various rows. So anyways, net income, let's say if net income, you would get this from the income statement. This would only affect retained earnings, so you would either add or subtract depending on a gain or loss. This does not affect common shares or contributed surplus. And then let's say if the company issued common shares, you would record that transaction. You would have no change in retained earnings, change in common shares, no change in contributed surplus. So these are just examples. This is not finite. A company could have some of these, a company could have neither of these. This is just like examples. I pulled this out from one of the class examples, the in-class activities. These don't always have to be the case. This is just one example of how it's done. So essentially, at the end, what you do is for your ending balance, you sum up all of this. Your ending balance for retained earnings is the sum of all of the effects on retained earnings. Similarly, the same concept applies to common shares, also for contributed surplus. And then this leaves you with the ending equity. And this total amount should equal the total equity amount on your balance sheet. Next up, let's go over some ratios. So earning per share. This was also at the start of the video, and it's basically the profit that each share produces. The payout ratio is the percentage of earnings distributed in the form of cash dividends. So it's the total net income, what percentage of that was given as a cash dividend. So you want this to be higher if you are an investor looking for income. Because if you're an investor and you want income, then you want higher payout ratio, right? Lastly, you have a dividend yield. This is the cash return for owning a stock. So it's the total dividend per share divided by the market price per share. Again, same concept applies. If you're an investor looking for income, you want this to be higher as opposed to lower. And then we have one more ratio. It's the return on common shareholders' equity. What this does is it measures a company's profitability from the shareholders' perspective. It basically takes the net income minus preferred dividends, and then it divides by the average common shareholders' equity. So you want this to be higher, greater than lower, because it tells you that you have more net income for your average common shareholders' equity if it's higher versus if it's lower. All right, that's chapter 11. Let's go on to chapter 12, investments. So quick recap, companies can buy portions of other companies through shares. So they will hold equity within the company. And the intention matters. You can either buy for example, trading where you just want to flip the stock price and make a quick buck, or you can buy for control. Let's say if you want to buy a competitor so you can control their decision making. You can also buy to increase market share. There are two kinds of purchases. There's either passive, or which is also called non-strategic. So you do this by increasing your investment income through bonds or shares. So this is either debt or equity. So you can either kind of buy bonds or buy shares of a corporation, and this is passive income. Your strategic investment is when you want to purchase a company or acquire shares in a company to enhance operations. So you kind of have almost ulterior motives, if that makes sense. And this is only done through shares because the bonds does not affect your equity in the company. Shares do affect your equity in the company. And if you want control and you want to have strategic enhancement of operations, then you need equity and control. So how is this recorded? So let's look at that. When you buy an investment, you debit the investment because then your investment is your asset. Assets increase through debits, and you credit cash because you're purchasing with cash. So at acquisition, the cost of the investment is equal to fair market value. So this is fair market value is basically what you would get if you were to sell that asset at that specific time. Here's how you record dividends being paid out. So part one would be dividend is declared. So your dividend receivable gets increased because you're expecting to receive dividends, and this is credited by a dividend revenue. And then let's say when the actual transfer payment happens, your debit cash happens because you're getting a dividend, and your receivable is wiped out. So essentially your receivable cancels out, and it's basically debit cash, credit dividend income. Next up, we are looking at the measurements of investments using the fair value to profit and loss. At the end of the reporting period, we update investments based on their fair value. The fair value is the current selling price if you were to sell. When you update fair value to the profit and loss, you will either have an unrealized gain or unrealized loss. The reason this is unrealized is because you're not actually selling it. This is just what would happen if you were to sell it. Therefore, it is not real, right? It's not real. It's unrealized. So you'll update the investment based off of the gain or loss. When you sell, your cash increases, your investment decreases. We've done this in a previous example as well, and you're either going to have a loss or a gain on sale. So measurement of investments, this is the second method. This is called cost method. So here you do not update the investment as per fair value. There are no unrealized gains or losses because if you don't update per fair value, you're not going to have an unrealized gains or loss. Your gains or losses are only going to be real through cost. You record the entry only when the investment is sold. For purchasing the investment, the entry is the same, but for updates, there is no update in cost. There is an update in FVTPL. There is only an entry for when the investment is sold, which will give you either a gain or a loss. No unrealized gains or losses, only real gains or losses. Your cash, when you sell, your cash is going to increase, investment will go down, and you either have a real gain or loss on sale. And then lastly, the last method is amortized cost. So we've seen this previously through the bonds. Amortized cost is only for debt instruments like bonds, and you will have interest payments which you use to increase or decrease the investment. So the discount / premium matches the fair value, the face value of the bond. And this whole point is honestly just a review from chapter 10, if you remember the bonds chapter, and this does not adjust to fair value. So amortized cost example, in class 12.4, where basically we purchased $100,000 worth of a specific bond, and this is the term, this is the interest rate of the bond, and this is the face value. So the market interest rate is 5%, which means we bought it at a premium, and at December 31st, 2020, the bonds were trading for $102,000. We purchased this a year before on January 1st, 2020. So we have a December 31st year end, and we treat the bonds as an amortized cost investment. So this is a long-term investment since maturity is greater than 1 year. So number one, what is the journal entry for 2020? So what we did is first we bought the investment. So debit investment, in brackets, always write amortized cost just so it's cleaner and helps you figure stuff out. And then you have credit of cash because you're buying it with cash. You just write the value you bought it at. And in this case, it's a premium. And next up, on December 31st, we get accrued interest. So this is our entry for December 31st. Debit interest receivable of $6,000 and credit interest income of this amount. And our credit investment is $863. So basically, our credit investment, this decreases the investment. We want it to decrease because we bought it at a premium. We want this amount to go down to $100K. And to do that, we need to credit it. And if you remember through the bonds chapter, how we calculate this is the interest receivable, since we're buying at a premium, is always going to be $6,000. And we're going to have two sources of kind of credits, where basically one of them is going to be the interest income. This is what we would have earned had we invested the $102,723 in the market at 5%. So we calculate this at 5%, which turns out to be 5,136. The difference between this debit and this credit is this credit. So we have a credit of investment, a reduction of $863.85. So what we do now is we take our $102,723 minus our $863 to get our new investment value at $101,859.15. This is at December 31st, 2020. So the amortized cost model does not need to be adjusted for fair value to profit and loss. Required 2 is how will bonds and anything related to the bonds, in other words, interest, be reported on the 2020 financial statements. So you're going to have an interest receivable of $600. So you're going to have an interest receivable of $6,000, and you're going to have a long-term asset of the total investment account. And this is going to be the new cost that we calculated after subtracting the amortized cost. Sorry, this page is a bit messy. I just kind of did this really quickly. required 3, what are the entries for 2021? It's going to look relatively similar to the previous one, except remember how before we had a receivable, we're just going to record the actual receivable of that receivable, which is going to be debit cash 6,000, credit interest receivable 6,000. And then next up, we're going to have the 2021 entry for this thing. So same thing, debit interest receivable of 6,000, credit interest income, which is going to be basically the new value, which is this, and we're going to multiply this by the 5% market rate. It's going to be 5092.96, and then we have a credit difference that we need to decrease of 907.04. This value is just this value minus this. And then, of course, we now have a new investment value where we subtract the 101 that we calculated earlier with this 907 till we get $100,952. So you essentially keep on doing this. I'm not spending too much energy on this because this is just a review of bonds as of now. And required 4 is assume the company sold their investments for $99,000 on January 1st, right after receiving their interest. So we would first have that same interest payment. The question only asks for the entry to record the sale, so I just didn't have that. So we sold the bonds for $99,000. Someone gave us $99,000 for the bonds. Our cash increased by $99,000, debit cash. And investment, so our investment went down to 0. So investment was previously worth $100,952. It's down to 0. So we credit it, right? We credit by the same amount, and now we have a difference of $1,952.11. This is going to be our loss on sale now. Cool, so there's the amortized cost example. If you want a less rushed presentation, then I would recommend watching the in-class recording. But let's go on to the equity model. So this is when you have an investment of significant influence where a company owns more than 20% of the shares. What this does is now you likely get a board seat. You can control the decisions of the company. So now you have significant influence in and of the company. Right, so the entry to record the initial purchase is the same, debit investment, credit cash. But when dividends are paid out, the investment value decreases by the dollar amount of the dividends. So because the dividends decrease net income, as I explained in chapter 3, the company now owns a significant amount of the net income. And because the dividends decrease net income, when we record a dividend as paid out, the net income decreases. So we decrease our investment value. Contrarily, when the company owned makes an increase in net income, the company who owns the shares, which is us, we will take that percentage of net income. So for example, if we have 30% of that company, that's significant influence, let's say they have $100K net income, we will take $30,000 of net income. So a quick note is the equity model does not account for unrealized gain, even if the share price increases. So we have no fair value updates. We have a company, we purchased 1,000 shares of this corporation for $20 a share, which is this amount, and we own 30% of the company, so we have significant influence. And on June 30th, the cash dividends are $5 are paid out, and on December 31st of the same year, the shares are trading for $25 a share. However, since this is equity and this is significant influence, this is irrelevant since we don't update the share price. Also, the company that we own has a net income of $100K. So what is the entry to record the initial purchase? Same as everything, debit investment, we're just going to write equity to make things a bit organized, and we're going to credit cash, and we bought this at $20,000 total value. Required 2, what is the entry to record the dividends paid? So we're going to receive cash, but our investment will decrease because remember, our dividends, since we own a significant portion of the company, they decrease our net income, which decreases our kind of total share of the company. They decrease our net income, which decreases the total amount of value we get from the company. And I purposely crossed this out to explain why, but basically required 3, what are the entries at December 31st? So on December 31st, the share price was 25, we bought it for 20, so technically we have a $5 gain per share, and if you multiply that by 1,000, you would usually have done debit investment 5,000, credit unrealized gain. However, the equity model does not account for unrealized gain, as we explained previously. So this entry is not supposed to be here, which is why I crossed it out. And then lastly, we know that the corporation has a net income of $100K and we own 30%. So we pretty much own $30,000 of the net income. So we're going to debit our investment by $30,000, and our credit investment income is going to be of $30,000 as well. And then so this is because we gain net income, we use this entry. Let's say corporation can also have net loss, right? It doesn't just have to be net income. So instead of debit investment equity, we would credit investment equity. And instead of crediting investment income, we would debit investment loss. This is a bit poorly laid out. I hope you understand my verbal explanation. If you don't, you should watch the in-class recording. And again, you do not record unrealized gain in the equity model, hence this crossing out. All right, chapter 13, statement of cash flows, almost done here. So quick recap. This is the last statement to be prepared. This dictates the company's ability to generate future cash flows. So a negative balance on the cash flow isn't inherently bad, but you need context. For example, let's say an established company like Walmart, they've been operating for many years. Their cash flow typically should not be negative because they've been operating for many years. If it's negative, it's a red flag. But let's say it's the first year of a new startup and that cash flow can potentially be negative, right? That's not too big of a red flag because it's only the first year, it's not established. However, if this is the case where every single year for the next 10 years, then that's kind of bad. And your cash flow statement covers 3 activities: your operating activity, your investment activity, and your financing activity. Really quick summary is that the operating activities are for current assets and current liabilities. This is what the business does to make money. The investing activities are for long-term assets. Your financing activities are for long-term liabilities or shareholders' equity. So a basic recap of the operating activities. You basically have the inflows and outflows of cash. So an inflow of cash could include something like a cash sale. You collect your accounts receivable. You receive interest. Also cash from sales of trading securities. So for example, you buy something and then you sell it for a greater cost, like you buy a stock and you sell it for a greater cost, you would only record the cash portion, not the unrealized gain or anything. An outflow of cash would include payments to suppliers like expenses, COGS, wages, taxes, and then any interest you pay. And then a quick recap of investing and financing activities. Investing is basically when you lend money and then you receive the loan payments. So basically investing would be kind of long-term assets, is like you're lending money and then the loan payments as well. All of these would be considered investing activities. Purchasing and disposing of long-term assets using cash, and basically changes to non-current assets. So long-term assets, any of those that are changed, would be kind of your investing activities. Now, it can be a bit confusing because when you lend money, you typically think of financing. However, here you are paying money to kind of purchase an long-term asset, which is basically just a accounts receivable in a way. So in a way, it's an investing activity. Lastly, we have our financing activities. For example, you get cash from taking a loan, or you sell common or preferred shares. You pay dividends to someone. Basically, your changes to non-current liabilities and or equity. So this is the layout of the statement of cash flow. So basically, you have your operating activity, investing activity, financing activities. You have a list of basically all the inflows and outflows, and then you have the net cash provided by or used by. If it's provided by, that means this specific activity generated positive cash flow. If it's used by, then that specific activity provided negative cash flow. Then you would sum all of these up, and then you would basically get a net increase or decrease in cash. And then you would add the cash from the beginning of the period to get the cash at the end of the period. This amount must match the cash balance on the balance sheet of the current year that you were working for. So let's go over the indirect method for the operating activities of cash flow. So you take net income, you get rid of all the non-cash revenues and expenses, and thus you're left with the net change from cash. So this kind of has like an opposite subtract kind of rule where all your expenses you want to add and all your gains you want to subtract. So even increases in current assets or anything you want to subtract. And this can be kind of counterintuitive at first, but if you look at my model for the assets, let's say if you have cash, and let's say if you have like inventory. So inventory is a current asset, and when you increase inventory, you decrease cash. So therefore, it's a deduction, right? Versus when you decrease inventory, you increase cash. So therefore, there's an addition of cash. That's how I kind of like to think of it. if you can't understand the concept of it, I would really strongly recommend just memorizing this and going through a couple examples using this model. This will allow you to understand it way better. So some tips for investing in financing activities is go through the balance sheet and determine which are the operating activities, investing activities, and financing activities. Like you're going to be given a balance sheet, determine which specific item of the balance sheet relates to which specific activity. Second step or tip I would give you is to record all the journal entries the question gives you. So the question is going to be like, here's a balance sheet, here's some of the entries, record this in the statement of cash flows. Cool, you'll do that for sure, but the third tip is to look at the prior year and current year account balance on the balance sheet. See if there's a discrepancy that is not already explained by a journal entry. So let's say if you have a truck balance, like a long-term asset for your truck. Previously it was $20,000, now it's $30,000. That means you bought a $10,000 truck, right? Well, if your journal entry tells you that you bought a $10,000 truck, that's great. Otherwise, that means you need to record the $10,000 truck, even if your journal entry didn't tell you to. So if the discrepancy is explained by the journal entry, great, you don't need to worry. If it's not, then I would recommend creating a T account to determine the exact reason why there's a discrepancy. I would strongly recommend going through the in-class activity or just watching the video lecture for that, because the professor explains it better than I do. And also, if your ending cash balance is not the same as your cash balance on the current year of the balance sheet, you did something wrong. So if this number is not the same as the current year of the balance sheet, you got to do it again. You did it wrong. So let's go over some of the ratios. Number one is the cash current debt coverage ratio. So this basically measures your short-term debt paying ability. This is cash from operating activities, and you divide this by the average current liabilities, and it tells you like what percentage of your current liabilities are able to be paid by the cash you generate from your operating activities. You want this to be higher rather than lower. Cash total debt coverage ratio, it's basically the same thing as above, except instead of current liabilities, you divide by total liabilities. Same thing, higher over lower. Free cash flow. So this is how much cash you have left from operating activities. So what this is you take the cash provided or used by, because you can have positive or negative cash flow, by the operating activities. You subtract net capital expenditures, which is basically what you purchased minus what you sold. And then you have dividends paid that you also subtract. All right, that is a recap of the entire course. I didn't go over chapters 5 or 6 since it's not on the final exam. However, shortly after, I will release a video going over those two, just so I can say that I made a recap of everything. But I am going to share some study tips that have helped me throughout the semester, and I hope they can help you as well when it comes to studying for your finals. So study tips is take whatever concept you're explaining, right? If you can explain that concept to someone else, that means you understand it really well. So what I do is, actually me making this whole video, I'm explaining the whole course to you, which kind of ensures that I understand it well, right? But basically, whatever concept you're working on, explain it to ChatGPT and ask it to correct you where you're wrong. If you can explain it, then you understand it, right? And let's say you explain a concept to ChatGPT, it tells you you're correct, boom, move on to the next concept. If you're wrong, then tell it to tell you exactly where you're wrong, re-explain the concept, and keep on re-explaining until you get the concept explained perfectly without any mistakes, and then move on to the next concept. Next up, this is my personal favorite, is we have those 5 quiz review documents, right? Download a PDF of them and upload them to ChatGPT. So you can get a free ChatGPT Plus subscription. It's free till the end of May for students to sign up with like your student ID. And so I upload that PDF to ChatGPT and I tell it this is kind of like the structure of my quiz. Generate me a 10-question quiz with 5 theory questions and 5 journal entries, right? This number, it's up to you, but like have a little bit of multiple choice, a little bit of true and false, and then some journal entries. And then now you basically have an infinite supply of quizzes. I personally did not purchase the Wiley Plus subscription or the Wiley Plus textbook, but I used this method. I really liked it, and it kind of just allows you to keep on practicing to practice problems. And again, this brings me to the next point. Do a lot of practice problems and maybe even redo old quizzes so you can kind of have the exact idea of where you messed up. Accounting, it's a very theory heavy class, but it's also a very practice problem heavy class. You need to have an equal balance of both to, I guess, do well on the final exam. And this allows you to practice the theory. This allows you to practice the theory and the practice problems. And then this just like tells you to practice problems. So I guess take these 3 tips. They worked for me. They might work for you as well. All right, that's the end of the video. So thank you so much for watching. I put a lot of effort into this video, and I really hope that it provided some sort of value to you. If you want to check out more of my content, I post a lot on Instagram and TikTok about just stuff like business motivation, life advice. My account is @_Lux Chopra on all platforms. Also, you're watching this on YouTube. If you go through my channel, it's my podcast. It's called Level Up with Lux. It's also on Spotify. If you want to consider checking me out, I also have my website up there, and I have my LinkedIn. If you're interested in more of my accounting takes, I talk a lot about accounting on LinkedIn. I have some hot takes about the industry. But hey, thank you so much for watching. I really hope you had some value out of it. And if you do, I really appreciate a like, share, comment, subscribe, anything. It just helps me out, helps out the algorithm. But overall, good luck for your final exams and have fun studying.